Happy Jobs Friday to all who celebrate. Everyone should be for one reason or another. It's almost 8:30 a.m. here in New York City. We are just 2 minutes away from that monthly jobs report. The Bureau of Labor Statistics expected to drop in just about 90 seconds here. Non-farm payrolls expected to show a gain of 165,000 for the month of August. This is seen as a make or break report in terms of what it means for the Fed's rate cutting pathway after September. And of course, you're taking a look at the unemployment rate expectation, 4.2% year-over-year wage growth expected to come in at 3.7%, Maddie.
Yeah, it's interesting in terms of the market action we're seeing heading into this print. One of my big questions, is this a market that is over-positioned for a downside surprise, or are they baying in line? Remember, the yield curve has been disinverting over the past couple of days here. We've got about 20 basis points of moves across the yield curve this week. Bank of America talking about how there have been bond flows. Bonds are getting inflows, whereas stocks are getting outflows for the first time since June over the past week here. So my big question, is this a market that is prepping for normalization that will be confirmed by these jobs numbers in just under a minute here? Or is this a start of broader deterioration, Brad?
And the unemployment rate going to get a lot of focus, of course, in this report, as it typically does. And here's why. And as we had heard from Fed Chair Jerome Powell at the Jackson Hole Symposium, BlackRock then coming out afterwards and saying a further rise in the unemployment rate helped stoke recession fears last month. Yet this was caused by an immigration surge, they point out, increasing labor supply there, not layoffs. So we expect, or they expect this week's data to show signs of job growth holding up, alleviating lingering growth concerns. We'll see where that figure actually comes in here in just a few seconds. But as of right now, taking a look at the futures, at this juncture, we are seeing some declines across the board for the Dow, the S&P 500, and the NASDAQ. Fractionally as they may be, still down going into this report. And we have 142,000 jobs added during the month of August, and that is the headline number. That's weaker than expected. And the expectation was 165,000, so that weaker than expected. You also saw the unemployment rate come in as expected, 4.2%. Average hourly earnings month over month, that came in at 0.4%, so just a tick hotter than what was expected at the 0.3%. And then average hourly earnings year over year, we told our viewers 3.7% was the figure to watch there. 3.8% is where it actually came in at. And so as we're taking a look at some of the reaction here in the futures, as of right now, we're still flat for the Dow, but we're still in negative territory across the S&P 500 and the NASDAQ at this juncture, Maddie.
Yeah, it's really interesting because we're seeing under the hood a couple of data points I want to point out. The number of people on temporary layoffs declined by 190,000 over the month of August. The number of permanent job losers was essentially unchanged. You also had the long-term unemployed virtually unchanged. Labor force participation rate remaining at 62.7% in August. Little changed over the year. I'm getting a lot of little change here and coming in just below that expected number by the tune of about 20,000 here. So that might be why we are seeing the major averages pairing their earlier losses. The NASDAQ pairing its losses in particular here as it starts to correct. But it'll be interesting to see how the market continues to digest this data, particularly across the yield curve as well, as we start to kind of look under the hood at the data in terms of what it means for the broader averages here. I do want to note construction employment rising by 34,000. That is higher than the average monthly gain of 19,000. Not a huge shift, but that was something that we were interested in looking at as an indicator of where the housing market is heading. So that could be a sign that we are continuing to have a little bit of construction in the broader housing market there, Brad.
Yeah, absolutely. Well, joining us now to break down the latest August jobs numbers, we've got Joe Bruce Whis, who is the chief economist over at RSM, and we've got Peter Cher, who is the head of macro strategy at Academy Securities. They've been sitting here just waiting to chime in on this discussion, and it's great to see both of you once again here to help break down some of this data. Joe, you're to my right here. First and foremost, I mean, you see a print like this come out weaker than expected on that headline non-farm payroll number, but as expected, largely on the unemployment rate figure. What does that signal to you?
All right, so when I took my first look at the data, my sense is that we got the downward revision last month, but we got an upswing of over 50,000. This looks like what we saw in July was largely due to seasonal factors, those temporary layoffs. Once we can get open the data set, what I'm going to do is I'm going to go look straight at the household. I'm going to see what was going on in temporary layoffs in general. Then in particular, I want to see if there was an upswing in people going back to work in the auto industry after seasonal retooling. If that's it, I'm going to set July aside and say that's seasonal issue. That does not mean that the labor market's turning over. It just means we're cooling. The 4.2% unemployment rate, well, guys, this screams 25 basis points at the Fed. This report doesn't scream 50 basis points, right, on its surface.
Peter?
Yeah, I completely agree. I think the unemployment rate is key. That's going to keep the Fed on hold. They're adjusting enough jobs this month, even with the downward revisions. So I think the market's going to have to digest probably only 25 in an only okay economy with people questioning AI. So I think you actually get a resumed sell-off today in the tech sector because they're not going to get the support they were looking for from the Fed, and there's still remaining questions about where the spending is going, and the economy's okay, but not great.
I mean, that is the larger question of if tech would be, because of the run-up we've already seen in tech to this juncture, and whether or not it would actually continue to have more legs, because tech typically, to your point, is a beneficiary during a cutting cycle. So how much more legs to the tech trade if we go into this cutting cycle and there's already been so much gains to be held?
I think we get back and test the August lows in tech. So I think you can have another 5-6% pullback in the NASDAQ 100. Then you start maybe getting some bottom feeders come in and say, okay, this is where it is. Because on top of this, we've got elections coming up that's very uncertain. There's definitely more and more questions about how much spending is really going, how the hyperscalers are doing. So to me, that's the vulnerable part. I do start liking the other market, though. I think the rest of the market that's been lagging, you start nibbling at that. I think it gets pulled down by tech a little bit, but this is all telling you, like, we're not headed to a recession. It might be a bit bumpy. There might be parts of the economy that are shaky. Others are strong. I get comfortable owning the rest of the market with that.
I want to go back to the macro with you, Joe, as you're kind of looking through the data. We saw payroll revisions over the past 2 months down a total of 86,000. Does that tell you that there is more weakness than we might be initially perceiving in this headline number in the labor market?
Not necessarily. It just confirms the cooling trend that we all identified. I don't think this is at risk, again, of the labor market just turning over. We're just going to cool. Remember, we only need to have about 100,000 a month to keep the unemployment rate stable. Okay, if you looked at the unemployment rate, which I just did while you were having a great conversation with Peter, 4.221. We narrowly missed a 4.2 here, right? And there was 168,000 increase in the household, so we didn't have a split decision. We saw the household actually increase a little bit stronger than the top line. That's a sign to me that there was more seasonal noise going on in July. So what we should expect to see, though, going forward is the trend cooling towards about 100,000 a month. When you're at full employment, like the United States economy is, and that's a good thing, it's hard to actually generate a lot of jobs. It just is, and they shouldn't, because firms have been hoarding labor for a number of years. When we conducted our middle market survey for the third quarter of the year, it was absolutely rock solid everywhere except for hiring. Hiring is just going to slow because they just don't need to add on any more people. Moreover, given the productivity data we saw this week, 2.5% in the quarter, 2.7% on a year ago basis, it's probably not a good idea for firms to begin to continue adding really large sums of labor every month, because then that will hit their balance sheet. And that's not really how you want to manage where we're at, really, which is in the middle of the current business cycle.
And when you mentioned the labor hoarding, how quickly do you expect an unwinding of labor hoarding to the point where it shows up in the unemployment rate?
Okay, well, we would need the economy to materially slow. Now, if you look at the Atlanta Fed's tracking model, which I think is the industry standard these days, it swings between 2 and 2.5%. That's not consistent with discharging a lot of labor. Moreover, if you look at the pace of firings, it's really stable. My friend Aaron Sojourner in Wisconsin, used to be a Treasury official, looks at every single week at employment stability and security. The job security for Americans right now is stunning. I mean, if you have a job, you're really not at risk of losing it.
I want to go to you, Peter, on this. Yeah, what were you going to say?
So one thing I've been doing is I really, and we'll go through this exercise this weekend, I only look at data from 2018 to 19 versus from the middle of 23 to now. I try and ignore all the noise that we saw through COVID, the COVID bumps, and you start looking at an economy that looks somewhat similar to 2018-19. Some parts are slightly worse, some parts are slightly better. I think on the jobs data, we got to look at the preponderance of evidence. You've got jolts down, but again, in line with where we were. Quits rates, hires rates, maybe slightly worse than 2018-19, but not horrible. Consumers still spending. So that, to me, I think it's a good exercise to go through is compare this to 2018-19, and you get less afraid than trying to compare it to that we're coming off from multi-year highs.
You know, just one other thing. We went through such an unusual shock right? You know, the unemployment rate went to 14% for a brief period of time, and then stabilized really somewhere between 6 and 8% for a good long period of time.
Right.
This is the most unusual business cycle in anybody's memory, and Pete's really spot on here. Going back and looking at cycles in the 60s, 70s, 80s, or 90s isn't really going to inform you about how this is likely to unfold. I think this is really, if you're out there trading or investing, right, or even if you're just watching because you're interested in the material affairs of the United States, I would not make the mistake of comparing what went on in those past business cycles to this, because the residual seasonality and the noise is clearly distorting the data, and we really can see this now.
I liked though what you were saying, Joe, about we should expect kind of 100,000 moving forward, but I want to get your take on how that could impact earnings, because typically you see a nice straight line between hiring and earnings growth.
So I think you're going to see a slowdown in earnings. I think one of the things we're going to face in big tech, a lot of the companies are facing more pressure from Chinese companies, not necessarily here, but you look at Germany, right? The biggest EV seller in Germany right now is Boyd or BYD, right? So you've got that pressure. I think you're going to see some of that there. And again, when you look at our markets, you've got these really high PE, high value stocks that everyone's loved and adored. They've been momentum, they've been driving the index. Then you've got a lot of companies that you can actually pick up at a pretty reasonable level. So maybe if we kind of take our eyes away from the golden goose and say, what else is out there? I think that's where you get the next 20, 30% returns, is finding those companies that have been undervalued, that people say, hey, we're in a normal cash flow environment, these businesses can do well, let's up
Small caps or?
Small caps, value. I think that's the way to look right now.
And so just lastly here, and I mentioned this going into the report, and it was coming off of one of the notes that I was reading earlier this week from BlackRock about immigration and how that's playing its way into, that's perhaps a differentiating factor in this economy versus any comparison that we would have had to cycles past here.
Yeah, immigration is the secret sauce in both just how robust the growth was in the labor market over the past number of years, and in terms of growth, 3.5% last year. We're at 3.1% year over year through the end of June. That's very good. And another thing, I do think that productivity number that we saw yesterday, we need to go back and take a look at that, because improved productivity means improved profits. And that's the key, especially if you're looking at the S&P 500 or the S&P 493, right? Those 493 stocks that didn't do all that well, but are starting to show
they're just not
signs
as
of life.
magnificent.
They're just not as magnificent. That's right, yeah.
This is great. You both speak each other's language very well, Joe and Peter. So I know you've got a celebration to get to with your post-jobs report dinner here. So we'll let you get to it. But thank you so much, both of you, for joining us on set. Peter Shearer and Joe Bruce Whis joining us. Let's do a quick check of the stock futures. You can see that markets pairing their earlier moves to the downside. You got the NASDAQ still down, though, down about 0.5%, but that is significantly better than what we saw before the jobs print of about 0.9% to the downside. You've got the S&P 500 nearing a little over 0.1% to the downside. The Dow is also under a bit of pressure. Now, this comes after the last month's July's surprisingly weak jobs was one of several factors contributing to the early August market rout. But how much of last month's warning signs could be chalked up to one-offs? Yahoo Finance's Alexandra Canal joins us now with the 3 key data points within this month's print to clarify the health of this labor market. Hey, Allie.
Hey, Maddie, and you're right. A big question heading into this report was whether or not the trends we saw in July would continue throughout August. Obviously, we talk a lot about the headline number of jobs added, along with that unemployment rate, but there are other numbers within this print that are key to compare month over month. One being temporary layoffs, which did contribute to the bulk of that unemployment we saw in July, but we did see those trends reverse during the month of August. Temporary layoffs declined by 190,000 to hit 872,000 last month. This was way below the 249,000 increase we saw in July, which, by the way, was the 3rd largest spike of this metric since the year 2000, excluding COVID. The number of permanent job losers, meanwhile, was essentially unchanged at 1.5 million in August. So this is a big positive when we think about the health and sustainability of this labor market, that temporary layoffs return to normal. Another key metric is hourly wages. That month-over-month increase was 0.4% in August. This was ahead of expectations. It was also up from the 0.2% uptick we saw in July. Over the past year, hourly wages increased by 3.8%, up from 3.6% in July. And considering inflation has been easing, the fact that we did see wages increase is a positive and also flows through into the Fed's dual mandate, which is keeping the jobs picture strong while also making sure inflation can ease towards its 2% target. target. And then finally, the labor force participation rate has been a big story, with some economists arguing that above-trend immigration is driving up labor force participation rates, therefore pressuring unemployment as more workers enter the job market. For August, the labor force participation rate remained at 62.7% in August. That was little changed a year over year, and the exact same number we saw in July. But if we do see a significant decline in that, that could flow through into the health and growth of the economy. So all of those metrics important to watch here, but it looks like, at least from a market perspective right now, that this is a positive report moving forward.
All right, Allie, thanks so much. Some key data points to continue keeping tabs on here in this report and throughout the next readings that we get as well here for reference. Everyone, before we go, let's do a quick recap of the jobs data here. Right now, we're taking a look at non-farm payrolls that came in during the month of August at 142,000. That is your headline number. Weaker than expected. The unemployment rate came in just as expected, though 4.2% is your unemployment rate for the month of August, and also reported by the Bureau of Labor Statistics, average hourly earnings. Year-over-year figure that came in at 3.8%. A tick higher than the 3.7% that was expected. We're also taking a look at stock futures as they've been reacting to this latest economic data point that's come out over the course of this week, where you certainly had a treasure trove of which. Dow Jones Industrial Average, as of right now, it's down by about 0.2%. The S&P 500 also about the same on a percentage basis in decline. And the NASDAQ futures, you're seeing that lower by about 0.5% right now. We'll be right back with more analysis on what this report means for some of your favorite stocks as we're 45 minutes out from the start of today's trading activity. Don't go anywhere. The August jobs report showing fewer jobs added than economists expected, while the unemployment rate, it came in line with expectations. And then our very own, of course, Angelique Hemlani and Danny Romero had to hop in on this chat, joining us at the desk for a deeper dive into some individual sectors. So, Danny, let's start with you. You've been keeping close tabs on the construction sector and that portion of this report.
It was no surprise that the construction sector added 34,000 jobs in the month of August. This is an area that has really seen a lot of strong job growth, Brad. But again, obviously, we have more to discuss in regards to construction.
Yeah, well, it was interesting because this was an area where Bruce Whis, an economist who was just on the show with us, he expected to actually see a little bit more strength in the construction sector. His colleague Peter Cheer, who was with us, though, said that actually we could see more declines in that sector as we start to see some weakness in the broader housing market. So it's interesting that we did see a gain, even though it wasn't as strong as we have typically seen in construction. It was just a gain of 34,000. Not a huge number, but still indicative, perhaps, of strength.
I mean, it did come in higher than the average monthly gain that we've become accustomed to over the past 12 months here. 19,000 was that average over the 52-week period. And then what's contributing to this? I mean, it sounds like, Danny, it's heavy and civil engineering construction. That really took the cake here, adding 14,000 jobs, putting the team on its back, if you will. And then you had employment in non-residential specialty trade contractors continuing to trend up as well in the last month.
Remember, this is a sector that is divided into two sections, right? We have non-residential construction and we have residential construction jobs. So the non-residential construction side of the portion really has been boosted by the Bipartisan Infrastructure Act. So we're really seeing a lot of strong, like you pointed out, the heavy and civil engineering. Remember, those are jobs that build our dams, our roads, our bridges. So that's really getting the boost from the Bipartisan Infrastructure Act. And then residential construction is a little bit unpredictable, we would like to say, just because we have seen a pullback in housing overall with housing starts, housing construction. So we really kind of see a little bit of this softness there in this report.
And we know it takes about half a year for any changes in the housing market in terms of construction to show up in the jobs data. Having said that, let's get over to you, Anjali, because I know you were looking at the healthcare space.
Yeah, healthcare, kind of a surprise actually. This month we saw 31,000 jobs added. Of that, 24,000 attributed to ambulatory care, which has been the stronger contributor to the gains, and then 10,000 in hospitals. And the 31,000 is half of the monthly gains that we've been seeing, that average. So I think that was the most interesting part. We've seen, sort of an up and down situation, as you can see on the screen, for the past several months, and this is possibly the new normal.
It's interesting, especially as we were talking about some of these sectors where people could really gain the most job security. We were discussing this yesterday on Wealth with one of our guests, and immediately, off the tongue, it comes out that we need more nurses, we need more healthcare workers, and that's continued to be the case here. The larger question is, at what type of rate will we see people flow into some of these jobs over the next few years in the pipeline for talent moving into those roles too?
Well, and the wage issue will actually help with that, because what we've seen is a decrease in the average wage for this sector, and that is good news because it helps bring down inflation overall for the sector, pricing pressures as well. And then in addition to that, could see more hiring as a result. Now, to the point of there have been shortages over the years, we know that's a conversation that's ongoing, but what we've seen is that the sort of higher cost professionals have been the highest in shortage, and then most of it is being filled in by nurses or those that haven't had as long of a time in training. So that's sort of where the industry is going.
All right, Anjali and Danny, thank you both so much for joining us to break down two very important sectors within this jobs report. Really appreciate it. Thank you. We're going to take a look at Treasury yields. Right now, they are tumbling after August non-farm payrolls missed expectations. Yields have been under pressure all week as economic data heightened September rate cut expectations. Traders now pricing in a higher chance of a 50 basis point rate cut rather than 25 basis points. And it was really interesting to see those moves. We saw on our CME Fed Watch tool here just a decline in terms of the degree to which traders were pricing in a 25 basis versus 50 basis point cut. And you can see the pressure on yields across your screen right now. You're looking at the 5, 10, and 30-year yield on your screen right now. So what can we expect from here for the fixed income market? We've got George Catrambone. He is the head of fixed income for the Americas at DWS Group. George, it's great to have you on. So let's just start about what we're seeing in terms of the bond market's reaction to this data and what that's going to tell us about the Fed's next moves, 25 or 50.
Sure. I think there's a little bit of a sense of relief because, whisper number was around this level. I think consensus was 164 or so. You came in lower, but not low enough to cause a large issue. So I think right now you're seeing the yield curve steepen and disinvert. We've had an inversion for a very long time. Starting to see that steepening come in, but it's the revisions that are the large problem here. This is now month after month of revisions, 111,000 or so revisions a couple months ago, a very soft July report overall with a lot of distortions, and now additional 2-month revisions. I think the bond market is looking at this. And now it's going to be incumbent on, I think, the last two speakers that are coming in. I think it's Williams and Waller.
Yeah.
They're the last word before we get into the blackout period to kind of clue the market in as to whether or not it's 25 or 50 from here. Right now, I think futures markets are pricing right in the middle. Maybe there's a 35 basis points or so priced in for the upcoming meeting.
So what type of duration should investors feel comfortable adding into their portfolio at this juncture?
Sure. Well, hopefully people were taking advantage of the duration when the entire curve was above 5% and starting to extend out. I think what worries me is the fact that people aren't talking about the $6.5 trillion in money market funds. So I think that's also part of the story, that it's not being priced out yet, and people are still sort of waiting in a complacent fashion. And I think that's a little bit behind the move that you've seen within that yield curve starting to disinvert. So I think, and overall, yields kind of come down amongst the curve, amongst a more difficult data set. I mean, people are looking at NFPs today, but let's also talk about JOLTS.
Yeah.
Let's talk about Beige Book, which Powell's going to be staring at, and the Fed committee will be staring at, if not already going into next week. So I think you need to start to press out. We still find the belly attractive. Maybe go in 2 5s and short, maybe long end towards 20s or 30s, start to take advantage of that steepening. Investors need to remember, though, it's not actually the inversion that causes the recession. It's the re-steepening of the curve itself that actually coincides with recession, if it were to occur.
I'm curious about the Beige Book that you mentioned. To me, that was my favorite point of this week.
Love that.
Being a little bit of a nerd over here, but you had 9 of 12 regions showing cooling. We know that Powell loves his anecdotal regional data. It made me think he's going to be gunning for 50, but the rest of the folks may not be on board for that. And again, we're still seeing the market kind of bopping around between 25 and 50. If you had to say what the bond market's telling you right now on 25 or 50, what would you say?
I'd say it's telling you 25 potentially in September, but that doesn't mean there's not a 50 in November, December.
Yeah.
I think that's effectively what it's saying, pricing at about, potentially 100 basis points of cuts this year. I think it starts to get ahead of itself with 9.5 going to 2025 and still saying we're going to have a soft landing. I think that's where it's a little bit of a question mark for me.
Right, because there's a reason that we would have to see 9.5 in order to, in order for the Fed to justify, and it would have to be a harder landing or just all-out recession, which, we'll see if the NVDA would even have declared it by that point.
Correct. Usually it's too late by the time you get there.
You're right.
But yes, I think overall there's a lot that Powell's going to have to sort through, and that's the direction of travel.
Really quickly, I want to talk about the yield curve disinverting. Just explain to our audience why that is such a big deal for this market and why we pay attention to that.
Sure. Obviously, when rates quickly move up, and we're moving at 75 basis points a clip just last year, 18 months ago, right? So that pushed front-end yields up and sort of long-end yields down because the risk theoretically is on the front end and overnight money, and the risk is right in front of you. So as the Fed starts to then ease that policy and get back to a more normalized curve, that front end should come down, and then the long ends start to go up and create more of a normalized growth trajectory. Typically healthy, but as you go from disinversion to inversion, that's normally sometimes when you see some stress in the economy actually start to show, although in a lagged way.
Right.
Really good stuff. All right, George, thank you so much for joining us on the heels of that report. We really appreciate it. George Catrombone, DWS Group's head of fixed income. Appreciate it. Coming up, we're going to have much more on that August payrolls report. Stick with Yahoo Finance for full coverage right here for more.
It's 9 a.m. here in New York City. I'm Brad Smith alongside Madison Mills this morning. This is Yahoo Finance's flagship show, The Morning Brief.
Good morning. Stock futures pairing earlier losses after that August jobs report showed fewer jobs added than expected, while the unemployment rate ticked just a hair lower. So let's get to it. The three things you got to know to start your trading day. Yahoo Finance's Josh Schaefer, Jennifer Schomburger, and Dan Howley have more.
A fresh read of the labor market showed the U.S. economy added fewer jobs than expected in August, while the unemployment rate ticked lower. Job gains clocking in at 142,000 versus 165,000 expected, while the unemployment rate falling 0.1% to 4.2%, which was in line with estimates. That's all according to the Bureau of Labor Statistics. At the center of Friday's report, though, is a debate over how severely the Fed should cut interest rates at its meeting later this month.
With the job market rebounding in August from July, but still cooling, Fed funds futures are fluctuating wildly this morning. Last look, traders were pricing in nearly a 60% chance of a 50 basis point rate cut versus 25 in September. That according to the CME Fed Watch tool. Fed officials are entering a blackout period today. New York Fed President John Williams said in prepared remarks before the jobs report was released that the job market is cooling from an overheated state and that it's now time to cut rates. Meanwhile, Chicago Fed President Austin Goolsbee told Market Watch Thursday it's pretty clear the path is not just rate cuts soon, but multiple rate cuts over the next year.
And Broadcom shares are under pressure this morning after their outlook failed to impress Wall Street. The move to the downside comes despite the chipmaker reporting an earnings beat in the third quarter. The company projected full-year revenue for AI products that beat expectations, causing investors to point to Broadcom's non-AI offerings as the drag on the outlook. CEO Hock Tan saying on the earnings call, Broadcom has reached a bottom in their non-AI markets, and he's expecting recovery in the fourth quarter. He also said AI demand remains strong.
Our top story this morning, U.S. futures reacting to the August jobs report here. Let's take a look at the futures. The Dow right now flat, just barely to the downside. The S&P 500 trying to make up its mind, and the NASDAQ futures as of right now also to the downside at this juncture. It's lower by about 0.25%, 0.3%, however you want to round that off. And this coming after the unemployment rate came in as expected, but it's that headline non-farm payroll that came in weaker than expected. 142,000 jobs added. 165,000 was what the street and what economists and consensus estimates we're looking for more broadly here, Maddie.
Yeah, I also want to take a quick look at treasuries here. We're seeing the yield curve bull steepens just a little bit. Shorter term yields are dropping. You can see the 2s, 10s slope here steepening a little bit, nearly about 3 basis points from prior to that print. It's interesting because we have seen the yield curve disinverting over the past couple of days here, but you're also still seeing a little bit of pressure across treasuries today, though not as much as we saw after that initial reaction from the jobs print took yields on quite a tumble, but now we're seeing a little bit of recovery here. But with more on what the numbers from this jobs report tells us about the health of this labor market and the broader economy and what it means for the FOMC later this month, we are joined by Yahoo Finance market reporter Josh Schaefer. So Josh, 25 or 50, what are you sussing out from this point?
The market says 50 now.
Yeah.
We're up to 60% chance on the CME Fed Watch tool, which sort of shows us the market pricing that we're looking at here. And I think, guys, when you look at the report, you could certainly see both cases, right? And I'm seeing economists all over X, that's my favorite thing to follow, right, on Twitter after this report, kind of arguing for both. And I think the case for 50 sort of comes from those revisions, right? You look at revisions, we added 86,000 less jobs than you initially thought in June and July. So the trend is lower in total job gains, and you also have the trend coming lower this month as well. I also think you look at the unemployment rate, it's rounding. We were at 4.26 last month.
So
now we're at 4, and now we're at 4.22. So it gets rounded down. But when you really get into that, you could still see some signs of weakness there. And it seems like what economists are sort of saying after this print is, okay, maybe the labor market is in a okay state. We didn't get a bad print, right, where everyone immediately screams, we need 50 bips, the economy is in trouble. But there was an argument to make a 50 basis point rate cut before this report, right? There were plenty of economists saying the Fed simply needs to cut by 50 because they need to get interest rates lower, and they need to get interest rates lower soon. And I think that argument is still alive and well this morning.
Well, it's a game of wants versus needs, right? They want the Fed to say, this is what the system needs right now, but the Fed is going to say, yeah, no, that's what you want. What we need is to put 25 basis points into the picture and then suss out from there exactly how the economy digests that.
I mean, that's how a lot of people feel like the Fed normally operates, right, Brad? Is that they would take sort of a steady Eddie approach here and go 25 basis points and wait until there's more concrete data that the economy is slowing. This report is not the concrete data that we could have had, say the unemployment rate stayed at 4.3, say payroll ads were significantly lower than people thought. Those kinds of things would have made it a very easy decision. Now it feels like the debate is still just alive and well, and it's a little bit of confirm your priors from before today. And if you were leaning 50 before today, you're still leaning 50. If you were leaning 25, you're still leaning 25. Right. I guess we'll hear from some Fed officials perhaps later today on what they think about it.
Yeah, it's interesting. We're already seeing the 50 basis points argument changing, like you mentioned, but moving towards November, December, maybe for 50. So it'll be interesting to see what this Fed commentary tells us about that path forward. Josh, thanks so much. Really appreciate it. All right, we've got fresh commentary, as we mentioned, out from the Fed ahead of that blackout period. That's going to begin at the end of today, 10 days before their September FOMC meeting. Here with more, we got Yahoo Finance's Fed correspondent, Jennifer Schomburger. Hey, Jennifer.
Good morning, Maddie. With the job market rebounding in August from July, but still cooling, those Fed funds futures, as you guys were discussing, are fluctuating wildly this morning. Last I checked, traders were pricing in a nearly 60% chance of a 50 basis point rate cut for September. Today is the last day before the blackout period, before the policy meeting on September 17th and 18th. And we did hear from New York Fed President John Williams in prepared remarks before the jobs report came out, in which he said the time has come to cut rates. Speaking in New York at the Council on Foreign Relations, Williams said, quote, "It is now appropriate to dial down the degree of restrictiveness in the stance of policy by reducing the target rate for the federal funds rate." He says the natural step now is down, now that he has gained confidence that inflation is sustainably falling back to 2% and that the labor market is cooling from an overheated state. He says interest rates can move down to, quote, a more neutral stance over time. Now, Williams said again in prepared remarks, comments about the labor market, in which he said that the job market is cooling from an overheated state. He thought that with the unemployment rate before at 4.3%, it had ticked up, but was still low by historical standards. He expects the unemployment rate to end the year at 4.25%. Remember, today the report saying that the unemployment rate now stands at 4.2%. Now, he is on the lookout for any further significant deterioration in the job market and what that could mean for the policy path. Meanwhile, we also heard from Chicago Fed President Austin Goolsbee late on Thursday, who told Market Watch that the direction is clearly down and that he expects multiple rate cuts next year as what the Fed has projected already. Guys, back to you.
Yahoo Finance's Jennifer Schomburger. Jennifer, I see the Capitol behind you, so you must have a big interview coming up. We'll be staying tuned for that later on for more on the state of the labor environment and the employment situation.
That's
Thanks
right.
so
I've
much.
got Acting Labor Secretary Sue.
Oh, we know it. We know it. Looking forward to it, Jennifer. Thanks so much. Let's bring in someone who is advocating for the Fed to cut by 50 basis points at its upcoming meeting. Joining us now for more, we've got Michelle Gerard of NatWest, the head of U.S. over at NatWest. We should mention, Michelle, that there are, as we were discussing a moment ago, needs versus wants that the Fed is going to be weighing. What are you expecting for the reality of the discussion to lean towards in their September 17th and 18th meeting?
Well, I think very much as you've talked about, this report won't push anybody off their prior position. If those who are leaning toward just moving more slowly at 25 basis points, there's enough resilience in these numbers that I think keeps that in play. Although I think, the 50 basis point camp, which, as you said, the market in reaction to these numbers is thinking is slightly more likely now. I think that, does come into play with those downward revisions. I mean, yes, the employment change was better than what we saw in July, and better than what we had looked, certainly than we were looking for. But with those downward revisions month after month, as well as those large annual revisions that have been reported, it's hard to take the numbers today at face value. So again, I don't think today answers that debate. But I guess the bigger question is, did it really come down to just this one report? To be honest, for the Fed, they're going to look at the overall trends and the broader landscape, and so they're going to have, I think, pretty much the same discussion at the upcoming meeting as they would have had with a different set of numbers. It doesn't come down to just one number for the Fed.
Yeah, and so let's game that out a little bit more. Next week, once we get Consumer Price Index, CPI, when that comes out Wednesday, you're also going to get a look at a better kind of more pulsed look at the state of employment with jobless claims as well, continuing to come out ahead of their next meeting. You're also going to have producer. I mean, you could pick your data point. How much do those data points actually carry more weight than what we're seeing in the jobs market play out, at least in the lagging indicator of the monthly jobs report for August?
Well, I think what we've seen is previously there was so much focus on inflation because the Fed's primary concern was whether or not inflation was going to credibly return towards the 2% target. And I think we've seen enough evidence there that the Fed is more confident of that trend being sustained, the downtrend in inflation toward target. And so the concern has now shifted more toward the economy, and the Fed is taking a more balanced approach. So they're looking at both the inflation numbers that we'll see next week and the employment numbers that we saw today, as well as, you said, some more up-to-date information. But again, I think importantly, stepping back, it's pretty clear in terms of the economy that things are slowing. And so I think for the Fed, the real discussion is, where do you think rates should ultimately, kind of be, or where do you think you're going to have to get to? Because I think that plays a big role in the size of the move that you're going to make. If you think that given where we are, we should be probably a lot closer to neutral in terms of the rate stance, somewhere closer to 3%, and you're at 5.5%, there's a lot of room. A 50 basis point cut in that context versus kind of dribbling it out at just 25 a time, there's certainly an argument that the faster you go, ultimately, obviously the quicker result you get to the economy, and ultimately, therefore, the less rate cuts that end up being necessary.
Michelle, it's interesting. I'm taking a look at the market action that we were seeing on the heels of this print, and you're seeing the Mag 7 moving to the upside. A lot of the big tech names are recovering a little bit. The Bloomberg Magnificent 7 index is up 1.5%, which is certainly a different story than what we saw earlier in this week. What does that tell you about the market's thesis about the Fed's path forward and the continuation, or I guess lack thereof, of the rotation narrative we've been seeing?
Well, I think what's happening is that, as I said, the market is edged up its odds for the Fed to move more aggressively, to move by 50 basis points, which is now kind of an even bet in the market as opposed to just 25. So you are going to, in the wake of today's report, there's a perception you're going to see more aggressive action potentially from the Fed. But at the same time, the numbers weren't disastrous. The numbers are more consistent with a soft landing. It isn't, the idea that you could still see the Fed take a larger move, but it's not prompted by numbers that were alarming that suggest that the economy is slowing a lot more dramatically than we thought. So that combination, I think, is probably pretty supportive for the equity market and for other asset prices. In a way, it's a little bit of the best of both worlds with, again, the idea the Fed could come in and do more, but the economy itself still showing decent resilience and nothing here that suggests you couldn't achieve a soft landing as opposed to, as opposed to an outright recession.
What does it mean for the tech trade specifically, Michelle?
You know what? We don't do equities here. We're a bond shop, a bond and FX shop. So I can't speak about the specific trends within the equity market.
Got it.
All that considered, Michelle, when you kind of game out, and I like the way that you put it in broader context of if they need to get to this terminal rate of 3.5 even, then what is a 50 basis point cut? But I guess on the other side, what is the risk that they run of cutting too fast, too quickly?
Well, again, given the posture of where we're at in terms of rates, that risk seems relatively low. But the concern is if you move aggressively, the market will start to price in even more aggressive action, which you might not feel is necessary. And of course, the biggest fear is that it ends up sparking, renewed inflation, or at the very least, sort of pausing the progress that you're making on inflation. If the market and the economy end up doing better, or there's greater economic optimism, then perhaps there's, again, companies are more willing to retain, kind of current prices, don't feel the need to be, we don't see those disinflation trends continue because they're, the economic outlook is more positive. So the last thing the Fed wants to do is to move aggressively and then end up having to, at some point, reverse course because they've moved too quickly and too aggressively out of the shoe. So that's the balance that they're clearly trying to strike. But I think the greater risk here is just falling behind. They have waited a long time to get confident on the inflation front. We do have tangible evidence of the economy slowing down, and you're still a long ways away from the neutral stance. It feels like, to front load a bit of the adjustment that needs to be made is certainly rational. And that's, I think, why it's on the table.
All right, Michelle, we're going to have to leave it there. Thanks so much
Great.
for
Thanks
joining
so much.
us this morning. Michelle Gerard, head of US at NatWest. Thanks. Well, shares of Broadcom have pared some of their losses, still under pressure, though, after its lackluster sales forecast for the fourth quarter overshadowing its earnings beat. You can see it's down over 5.5% right now. Now, the Apple supplier is benefiting from a surge in AI spend, but its other divisions are falling short. For a deeper dive into the results, we are joined by Daniel Newman, Chief Executive Officer of the Future Room Group. Daniel, it's great to have you on. Appreciate you making the time for us. So I specifically want to focus in on their AI revenue coming in at $12 billion. They raised that AI revenue guidance, and the business, of course, growing. Is that going to be enough to sustain Broadcom moving forward? It seems like the street doesn't think so.
Yeah, clearly the street wasn't happy. They were looking for some sort of outsized number, maybe 13 plus, the whisper number. The same thing happened with Nvidia, came up with a pretty significant guidance upside. But this is a little more of a story about the diversification of the business as well. So the AI business is performing. You're going to have some complicated networking that Broadcom is going to help solve. And of course, these accelerators, these AI processors, Broadcom's in the driver's seat. They have won some really important designs. We know, or we speculate about Google, and of course, ByteDance. We heard about OpenAI. But at the same time, it's kind of like these 3 or 4 other parts of the business. So you've got their sort of core connectivity and networking business. That was a little bit off. Clearly, investors weren't happy to see that, but that's off market-wide. That's a macro issue. And then, of course, the VMware acquisition was a big one. But that part of the business performed really, really well. So when you kind of look at what's happening here, I think it's a company that was priced well. People thought AI was going to maybe have this explosive beat, and the core business has slowed a little bit, but has some favorable conditions to rotate back over these next few quarters.
Yeah, you mentioned VMware. They talked about, and Hock Tan, the CEO, talked about VMware bookings continuing to accelerate here. What type of net contribution to earnings over time are you modeling out for what VMware will bring to Broadcom here?
Yeah, we think that the VMware acquisition has a really strong play. I mean, Hock Tan came out at the recent VMware Explore, and really he wasn't going to compete so much directly with the normal competition, the Red Hats or some of the other virtualization softwares that we're so familiar. He really came out swinging and saying, look, we're going to compete with the public cloud. We believe that we can bring dollars back into enterprises, give them public cloud platforms, and help their businesses scale. Now, so far, despite some of the the way that Hock maybe is characterized in the market for how he runs his businesses, the software businesses, whether that's been CA, Brocade, now VMware, they perform well. He right sizes the businesses, he grows them. And I mean, that 60+% EBITDA contribution that he makes across the business is really, it's really important to the overall business. Having said that, it's going to take some time, and we need to see some proof points that this new private cloud solution, this new AI solution is going to land. I'm optimistic, but like I told Hock when I spoke to him last week, we need to see it in the numbers.
Well, that's fascinating, by the way, but I'm also curious about this idea that I've heard from some investors that they want to see Broadcom taking on an additional hyperscaler that they're going to make a chip for. I mean, right now, about 18% of their revenue is coming directly from Apple. In your conversations with Hock Tan, did you get any indication of a path forward for another hyperscaler to come on board?
Of course, we are hearing about some of the opportunities that exist out there. We know there's only really a couple of companies playing in this particular space. There's Broadcom and of course Marvell. They are very tight-lipped. They have certainly made indications that there is more opportunity out there. This $12 billion number has a lot of that XPU in it. And our model, our forecast for the chips market is showing that this accelerator market is going to outpace the GPU market by somewhere between 15 and 20% over the next 5 years. And so we know that whether it's the Microsoft and Amazon and of course the Google TPUs, we heard about ByteDance, OpenAI, and then that's going to drive Apple. So across the board, we know that these AI accelerators are going to go big. And there's this whole compete situation going on with Nvidia. No one really wants to talk about it, yet everyone wants to talk about it. Is there a DOJ probe? What's going on? But that competitive landscape, Broadcom plus an AMD plus an Intel Gaudi plus a hyperscaler accelerator does offer the most complete opportunity for something that could compete with Nvidia. So it's a compelling story. They're not going to leak this per se, but all indications are this accelerator market's going to grow really quickly.
Just while we have you as well here, Dan, one of the other stories that we're tracking, the Biden administration rolled out some fresh export controls on quantum computers as China continues to make advances in the global chip industry. I mean, it's not even just the U.S. at this point. You've got Japan also making some sweeping adjustments there. I mean, my goodness, the Netherlands too. Don't upset the Dutch on this matter, but what does this mean when you have so many different countries and this latest effort from the U.S. to really try and curb or at least protect even more intellectual property? What does that signal to you?
Yeah, brother, it's interesting. I shared this morning some rumors out that in China, renting an A100 or an H100 actually costs less than in the US, which is the indicator to me, and we always talk about this, that China is getting enough supply, even though they're not supposed to be. So these controls they're really complicated, very nuanced, whether or not they work well and how effective they are. Having said that, the semiconductor supply chain is really complex. And you mentioned the Dutch, Japan, there's so many different parts. And by each one of these parts not being able to support China's needs, it creates more difficulty for China to really get to those most advanced nodes. The world, of course, wants to make sure that it maintains a global leadership position in semis as we move into 3 and 2 and these newest nodes from TSMC and from other foundry providers. They want China to be behind for a few years. I always say, Brad, don't rule them out, but the global supply chain of semiconductors and all of the policymakers are certainly going to make it very hard. I expect China to fight hard against it, but I don't expect this to slow down these policymakers and some of these export controls.
Daniel Newman, thanks so much for joining us this morning on All Things Chips. We appreciate it. Daniel is the Chief Executive Officer over at the Futurum Group. We're going to have all of your markets action ahead right here on Yahoo Finance, so stay tuned for more. You're watching Morning Brief. It's now time for some of today's trending tickers. Throughout the trading day, you can track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. You can scan that QR code that you see on your screen right now to check out the latest there. But first up, I'm going to be taking a look at shares of DocuSign. This comes after the company posted an earnings beat. But analysts did express concern about the company's billings growth. You can see those shares recovering right now up over 4%, but there was initially some pressure in the pre-market trade earlier this morning, down about 1.6%, and that billings growth was seen as the key sticking point here, Brad. The margin performance was a positive, but there are questions about that billings growth moving forward and whether that signals any type of weakness in the broader economy for a lot of the clients that DocuSign works with here.
Yeah, if you have questions, here's your answer. As they mentioned previously, and they said this on the earnings call, so you can check this out in the transcript as well. I have it in my notes. We expect Q2 billings growth to be our lowest quarterly growth rate in fiscal year 2025. So perhaps there's a trough for the billings growth rate, but for the street, they're trying to get ahead of, okay, what if it's not? Mm-hmm. Is that, to your point, spelling out something that is far more indicative of a larger trend, and especially for a DocuSign, which, like many companies, is probably facing more deal scrutiny, elongated deal cycles here. So that's going to come into focus. International revenue, though, that was pretty good, though, represented 28% of total revenue and grew to approximately double the rate of their overall revenue here. So that global expansion strategy really key for the company, an important component of that long-term vision that they're continuing to communicate to the street. It's not all bad news here that I try to give. Some good news here. Yeah.
A mixed print, as always, but that'll give us a lot to talk about because Yahoo Finance Executive Editor Brian Sozzi and I are going to be speaking with DocuSign's CEO just after 10 a.m., so stick around for that conversation.
Can't wait for that one. I'm going to be watching that one. Thanks. Also checking in on shares of UiPath. Shares jumping as revenue comes in better than analysts had expected here. We're taking a look at some of the actuals and at least the actual reaction here that the street is having. It's up by about 7.6%. A few things that I jotted down after this earnings call here. Number one, their customers with $100,000 or more in annual recurring revenue, that increased to 2,163. Customers with 1 million or more, that increased to 293. So positive news there. They also expanded their share repurchase program, check plus mark there. And then additionally here, overall, second quarter overall gross margin of 83%, continued adoption of cloud products, software gross margin 87%, not too shabby.
And a $500 million share buyback as well. So that combined with the guidance being positive, certainly an upward catalyst for the stock. We're seeing a couple of price target changes for UiPath this morning.
That's right. All right. Well, we're continuing to track UiPath more broadly here. Take a look at that past month move. It's up by about 14% here. We'll see if they can hold on to some of those gains. They also mentioned that they did exceed the high end of their guidance across all key financial metrics, a testament, they say, to improved execution and the compelling value that their AI-powered automation platform delivers. All right, let's take a look at the opening bell. And oh my gosh, all right, we're not even going to talk about the New York Stock Exchange and those giants that they got ringing the opening bell over there. The Eagles play tonight at 8 for anybody who needs to know. And then additionally, at the NASDAQ, you've got Arcutis ringing the opening bell. They get some funfetti. Just take a good look at the NASDAQ. Fun group of folks over there. Don't pay attention to those Giants jerseys that you see at the NYSE. It's all good football fun here. Crazy game last night too, Maddie. But anyway, this is a financial show, so we'll stay there. Maddie, I'll toss things on over to you. That's the opening bell.
Thanks, Brad. Well, it's interesting because I'm taking a look at what we're seeing on the major averages as they start to kind of relax here after we got that opening bell. I want to take a look at the two-day chart here because you can see a little bit of that recovery that we were getting in the S&P 500 on the heels of that non-farms payroll report. It's not enough to erase some of the gains, or the losses rather, that we've seen throughout the past week. And you can see here the S&P is still down nearly 1.5%. But I want to take a look at the NASDAQ intraday right here so that we can see, as obviously the market has just opened, but you can see that the NASDAQ is up about 0.2%. And it's interesting to me that we are seeing tech recovering. You can see all of your Mag 7 names here in the green following that jobs print. And it's interesting to see even Nvidia, which has had a tough week, up about 0.3%. This to me could be an indication that there was some signal of risk in that non-farm payrolls print. When you look under the hood, some of the data indicating some cracks in the labor market. Sometimes in the equity space, the big tech names are considered some of the risk-off moves because this market market has been able to kind of rest on its laurels of the AI-driven rally so much throughout the past year here. Having said that, really quickly, I want to check on semis after those Broadcom earnings. So we are seeing Broadcom still clearly in the red as it starts to head into the day's trade here after the market open, but we are seeing some gains on Nvidia and TSMC, so it'll be interesting to see how the chip sector closes out the week. Is that non-farm payrolls print going to be enough to lead to a broader rally within the tech space that hits the chip sector, or is it just those Mag 7 names that are going to lift the market today, Brad?
All right, thanks so much. Let's stay with some chips here as well. Some trending tickers here at the open that we want to check in on. One of them, Intel, the embattled chip company, receiving an analyst downgrade today, and there are reports as well that the company is weighing a sale of its stake in Mobileye. Shares are down by about 0.5% right now. So let's start things off with this downgrade. It came from Erst Group, and they were really looking at Intel and this downgrade from hold to sell. According to this analyst, we have a lot of factors that are at weight here. Number one, a cautious outlook. They're taking a look at some of the competitors, calling them more robust, AMD and Nvidia particularly, and the roads that they've made in AI to this juncture. Now, you remember that Intel right now, within this competitive landscape, they have a lot of the valuation that's really kind of putting them back, or at least tied back to this PE ratio for the year, considerably higher than that of its peers. And so with that in its mind, the valuation of Intel relative to the rest of the market, or at least in comparison to the rest of the peers, they say the upside is currently limited, and so that's the reason for the downgrade there. Oh yeah, and then of course you have the selling of that Mobileye division as well. We'll see if that comes to fruition, but that is at least what's reported at this juncture here, and some interesting potential suitors as well and buyers for that.
Yeah, well, it's interesting that Mobileye shares are down on the heels of that news that Intel is considering exploring a sale of that stake. But what stands out to me is that Pat Gelsinger, he has had a busy couple of years, certainly a busy couple of weeks. We had that news about Intel potentially selling off their foundry business. Intel has been a beneficiary of some of that weakness in the chip sector that I was talking about earlier, as potentially a positive catalyst for the stock could be the increase of domestic production of chips, but it hasn't been enough to make Intel sort of a safe place to be for investors, and certainly for Pat. I think he's dealing with a lot of big questions in terms of executive leadership at the company moving forward.
Yeah.
All right, well, we're going to have all of your markets action ahead right here on Yahoo Finance. You're looking at gains on the S&P 500. The NASDAQ is just about flat. Stick with us for more.
Let's get more on the market action to the payrolls report with NYSE senior market strategist Michael Reinking here. Michael, thanks so much for joining us in studio here on the day.
Hi, Brad. Thanks for having me in.
Absolutely. All right. So you saw the data like we did this morning. Non-farm payroll headline number came in weaker than expected. Unemployment rate, slight tick lower here, but ultimately, what is the market latching onto from your perspective here?
Yeah, so I mean, I think unfortunately, I don't think today's data really gave us a definitive answer in many ways, right?
Which is weird because the CME FedWatch probabilities, they jumped and we saw a significant switch there.
Well, I mean, we're back to kind of a 50-50 between 25 and 50 basis points. So I mean, that is a coin flip, right? So it doesn't necessarily give you that definitive answer, which I think everybody was really hoping for, right? So we did see a little bit of improvement in the headline non-farm payrolls number, but the revisions to last month, really kind of offset that quite a bit, right? And if you look back historically, we do tend to see positive revisions to July. So the last 7 Julys we've had positive revisions, right? So that actually strikes me as a little bit more negative. From that perspective, we also tend to see positive revisions in August, right? So 15 of the last 19 years we've seen positive revisions. So that'll be something to pay attention to. I think in terms of the unemployment rate, right, the bar was very low for that to tick back down to 4.2%. It was really kind of a rounding error as of last month, and we did see kind of that move lower in the temporary layoffs that people were kind of focused on from last month. Unfortunately, I don't think it gives you a definitive answer from a Federal Reserve perspective, right? There's a lot of would've, could've, should've that'll kind of play in here. I still lean to the idea that we'll probably see 25 basis points at this point. Just given that that the central bank likes to move methodically with consensus, and unless we start to see, today's the last day before the Fed blackout window, so unless they start to get some messaging from either Fed Williams or Waller today, I'd be surprised to see a 50.
Is the equity market accurately pricing in, I don't want to say softness, the slowing, maybe the normalization that we're seeing in the labor market that's not necessarily yet at a deterioration, but is the equity market ready for that slowness to continue that we've started to see as a trend?
Right, I mean, and I think that's really the big concern, right? So, do you start to see that snowball effect? And that's, and that kind of goes back to the Federal Reserve and the would've, could've, should've. If they had cut in July, right, that would have been, could have signaled that as a more preemptive cut. At this point, it's a little harder to say that the embarking on an easing cycle from here is really preemptive. Right now, we're starting to get into that reactive phase. And then in terms of kind of equity markets, right, it's gonna take some time. You did see quite a bit of clenching up ahead of this number, right? You saw the VIX moving back into the low 20s, right? A little bit of deja vu to the start of August, right? And so from here, I think there's a lot of kind of things you can watch. Definitively at the open, we're not getting a clear signal from the markets. We're at the S&P 500 is at a key technical level right around 5,500 with the 50-day. Seeing the VIX move back below 20 is a positive, right? So that may be a little bit more supportive. And then we need to kind of watch the currency situation as well.
You mentioned the Fed speakers that are going to be out in force today before that blackout period begins here. And I mean, Williams is out speaking today, essentially, catch these bars before the blackout period. And one of the things that he's saying is now seems appropriate to lower the Fed funds rate. He goes on to say that he's ready to start the process of rate cuts and that there's confidence rising as well, that inflation pressures are ebbing. All of that considered, the pathway and the process, what do you think that leads them to in terms of the thinking towards the next terminal rate that the markets might have on the docket here, or keep in mind?
Yeah, and that's really, I mean, I think there's a lot of debate about 25 or 50, but I think you highlight the right point, right? That it's really the destination. It's not how we necessarily start this process. Markets are pricing in over 200 basis points of rate cuts by the end of next year. If you think about that and look back to previous cutting cycles, right, that is, at the start of that cutting cycle, we're already pricing in more than markets had in previous cycles, right? So we've seen, markets get ahead of themselves multiple times during this cycle. You think back to kind of the beginning of the year, right, and where we were pricing in 6 or 7 rate cuts by the end of this year. So hopefully, I think, from my perspective, you want to continue to see the economic data come in reasonably strong, you want to see less rate cuts. You don't necessarily want to see 200 basis points of rate cuts, right? A slower process will be better received by equity markets.
I'm fascinated by the moves that we're seeing in the equity market today. When we took a look at futures on the heels of that NFP report, you did see a little bit of a rally in some of the big tech names, particularly in the Mag 7. Now that's reversing. Now we're seeing pressure on Nvidia. We're seeing the NASDAQ under more pressure. It had kind of reversed its earlier downside moves, and now we're right back where we started. What does that tell you? Is this a risk-off move? Is the market freaked out about the non-farm payrolls? What is the thesis here?
Yeah. I mean, at this point, kind of hovering around unchanged. Right, we had a couple of days, where we pulled back. We started the month of September, pretty negatively, and I think this is more of a digestion move. It's really hard to say we're getting a definitive answer here in the first 15 minutes of trading. I would say, watch that 5,500 level, right, in the S&P. See, we want to get back above the 50-day moving average. There is a gap down, from August 15th, when we had the retail sales report, right around 54.60, right? So filling that gap, might make some sense, but then I think really just paying attention to volatility, right? Because we've seen the systematic flows that have been driving this market, right? It really drove the market in August, right? And we're going to continue to see that. So if we can't see the volatility start to compress again, right? That's going to bring in some more of that systematic de-risking. And as many of your guests have pointed out, September, October does tend to be kind of a difficult time period. Not only just from a general seasonal perspective, but also ahead of elections.
Just lastly here, one of the huge questions that has been my favorite question asked over the course of this week, because tech is always sexy to talk about, but historically, we've seen tech be the beneficiary of rate cutting cycles. Do you think that's the same case this time around, given how far tech has run at this juncture?
Well, tech has really become sort of this, it's evolved over the last couple of years, right? And they've now become, these all-weather stocks, right? So depending on the environment, you can make the case that it's a defensive stock or not, right? I think what we're seeing kind of right now, is very much driven by the AI, kind of by the AI momentum, and we're having a little bit of a gut check, right? So, there's a bit of a digestion phase that we're starting to see, kind of with all of this AI leadership, right? There's questions, there's bigger questions about the spending, when we're going to start to see, kind of that start to help and impact the bottom line, and it's going to take some time. So I think there's a bit of a digestion phase here, that can lead to stocks. Stocks can correct, via time or price, right? So if we can see some of these stocks just start to stabilize, right, and that will kind of allow the breadth of the market to kind of hold us up and continue to move higher. We just need to see some stabilization there.
All right, Michael, thank you so much for joining us this morning. Really appreciate you.
Not just
coming
joining
up
us.
from the NYSE.
He left his Giants at the NYSE to the NYSE to come be with us. Thank you, Michael.
Season,
that's nice.
Appreciate it, guys.
Best time of the year. All right, Michael, thank you so much. Really appreciate it. Coming up here, we're going to have more of your markets action ahead. So stay tuned for more. You're watching Morning Brief.
Welcome back to Yahoo Finance, live from the Labor Department here in Washington, D.C. I'm Jennifer Schonberger. For more insight on this morning's jobs report, I want to welcome into the program Acting Labor Secretary Julie Su. Secretary Su, always great to see you. Thanks so much for joining me.
Thank you.
We got a bit of a weaker payroll number than expected, showing a continued cooling trend, but still a rebound from that much weaker July jobs report. To what do you attribute this rebound? What is happening there? What's the dynamic?
Yeah, look, I mean, this is a continued sign of what we talk about month after month, which is we are seeing steady and stable job growth. This is part of the transition from the breakneck speed of job growth that we saw in the initial years of the recovery. Again, none of that happened by accident. Many people predicted it would not be possible. A lot of people said we would not get to a 4% unemployment rate for a very long time, and we defied all those expectations. And so this is a continued steady, stable job growth, 142,000 jobs, while labor force participation rate remains steady, and the unemployment rate still remains the lowest for the longest stretch it's been in decades. And so this is the sign of an economy that is very, very strong.
Continued stable job growth, you say, but we are seeing a cooling trend. When we look at the revisions today, for instance, June now only 118,000 jobs, July only 89,000 created, of course, August 142,000. My question is, how much more can we see the labor market continue to cool without a recession?
So that R word has been thrown around for some time. And, by contrast, everybody said, will there be this soft landing? I think what we've seen over the last year, and, the last few months are no different, is that coveted soft landing. It's a labor market that remains very strong, that by all indications, especially when you combine it with our strong GDP growth, the battle against inflation, the labor force participation. Again, women in the labor force broke the last record which we set, which was in May. Overall, right, the indicators of the economy are of strong, robust growth and not recession.
The preliminary benchmark revisions that we got a couple weeks ago showed that job growth from March in the prior 12 months was actually lower by 800,000. Do you expect further revisions like that for the balance of this year?
Revisions are part of what the BLS does. It's nothing out of the ordinary about that. It's the reason why we can come out every month and provide data, and then because of the reliable and transparent way that BLS operates, provide revisions afterwards. And so,
but it's possible we could see weaker job growth given the trend we've seen, right?
Yeah, we can see revisions both up and down. That's true in all administrations. And again, it's a sign of why the BLS data is considered the gold standard is because it's able to be released quickly and then revised as more data comes in.
You just said the BLS data considered the gold standard, and I do want to ask you, because there's debate right now about whether the BLS and the census are undercounting immigration. In fact, Brookings just came out with a study recently finding that U.S. and foreign-born employment increased more than published data show. So do you think that the household and establishment surveys are undercounting?
Right. I mean, so the data, this is the largest amount of data collection about the state of our economy, the state of the labor market, the unemployment rate as exists. And so, certainly we continue to data collection. It is an art, not a science. It requires us to, reach out to households, and sometimes they respond timely, sometimes they don't. Sometimes we can do it by phone, sometimes we have to knock on doors. And so there's always, the effort to make sure that the data we get is as comprehensive and as accurate as possible, and then we make revisions when more data comes in. And it's for a very long time, the BLS data has been considered reliable because of all that work that goes into it.
Switching gears, Secretary, I want to ask you about a couple of looming strikes. Do you think that Boeing and its factory workers will be able to come to an agreement by the deadline of September 12th and avoid a strike? What are you hearing from both sides now?
So the parties are at the table and they're negotiating. We've said from the very beginning that this administration supports collective bargaining. We believe that unions trends are good for this country. And the jobs data reflects that, right? That we can build an economy in which workers come first, in which workers do well, and supporting collective bargaining is a part of that. And so, we encourage them to stay at the table, and the parties always seem like they're far apart until they're not. It's something that I've certainly seen firsthand, and so it's premature at this point to talk about an actual strike.
And along the same wavelength, a contract for longshore workers on both the East and Gulf coasts are set to expire at the end of this month. But there is pushback from the union about automation. The union is concerned that technology is taking union workers' jobs. Right. What do you say to that union and other unions who are concerned about AI and automation?
Yeah, I mean, this is why the president has been all in on making sure that in the development of artificial intelligence that we look out for workers, that we make sure that AI does right by workers. And this automation question is not limited to the ports. It was also an issue in the West Coast ports. And we know that we can build an economy, build a world in which we use technology for the things that it can do to make our lives easier, make our lives better, right? Eliminate maybe the most grueling and repetitive tasks, but make sure that we also protect workers and good jobs. And that's a big priority for this administration. And we know that when workers have a voice in determining how technology will be used, how it will be implemented, that's good for working people too. We see that across many industries. And so that's another reason why unions and collective bargaining are positive forces.
We'll have to leave the conversation there, but Secretary Sue, thank you so much as always for your insights. So appreciate it. We'll see you soon. That's Acting Labor Secretary Julie Su. We will be right back after this.
We're taking a closer look at Yahoo Finance's trending tickers. We've got Big Lots, we've got Super Microcomputer, and Chewy. We're doing it in 30 seconds each. Let's go. First up, we've got Big Lots. Shares, they are on the move higher right now by about 16%. They did postpone, though, the release of its second quarter earnings from today to September 12th. This comes just days after the discount retailer was said to be mulling a bankruptcy filing, according to reports here. So, if they are indeed nearing that bankruptcy, that would, of course, move a lot of investors to believe that ultimately that's the pathway that we should expect instead of more quarterly earnings reports coming forward.
Yeah, absolutely. It's interesting to see the degree of that stock move too, Brad. But I'm going to take a look at Super Microcomputer. Those shares lower after JP Morgan downgraded the stock to neutral from overweight. Analysts behind the call say the decision comes from uncertainty around regaining compliance with regulators. You can see those shares down over 3.5%. Now this story is like my Roman Empire. SMCI delayed their 10K filing after a Hindenburg research report saying that they had some accounting issues. And JP Morgan is just saying, listen, this is not the time to get in on this company. Stay on the sidelines for now, Brad.
All right, and Morgan Stanley remains bullish on Chewy, reiterating its overweight rating here. The firm, they highlighted Chewy's potential for margin growth, saying the pet supply retailer could significantly beat street expectations for EBITDA next year. Shares right now, they're up by about 3.8%. They said the profitability upside makes it easier to underwrite the valuation. Everyone, we've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Welcome to Catalyst. I'm Madison Mills alongside Brad Smith. We are 30 minutes into your trading day. We're watching three catalysts impacting the market: the August jobs report, rate cut expectations, and the rotation out of tech stocks.
That's right. Stocks right now, as we're taking a look at the major averages, we've got that on the bottom of your screen for you here so you can keep tabs. As of right now, the Dow is higher by about 0.3%. The S&P 500 lower by 0.3%. NASDAQ Composite lower by 0.9%. And this is all after a somewhat mixed August jobs report here. Non-farm payrolls, they missed expectations, while unemployment was in line. It did tick lower from the prior month to 4.2%. That is a rounding thing, and we'll get into that a little bit more. We also saw year-over-year wage growth come in above expectations. We'll dive into the market's reaction to this and how you can play the choppy market.
That's exactly right. Rate cut expectations seesawing off the back of that August jobs report at 1.60% of, actually, I'm so sorry, at 1.60% of traders were pricing in a 50 basis point rate cut. Now the consensus leaning once again toward a 25 basis point cut. Investors moving toward November and December as possible dates for a 50 basis point cut at those upcoming meetings rather than at this September's meeting. We're going to dive into how the market is pricing in the Fed's moves.
Plus, investors' AI expectations go unmet once again. Broadcom following Nvidia's footsteps with a beat that just wasn't good enough for Wall Street. But just because the flashy prints aren't over, or, well, they are over, doesn't mean earnings season is done. We'll keep tracking the heavyweight reports to come from the likes of Oracle. We've got FedEx, we've got General Mills. That's coming during the month of September, and that offers key insights into the health of the economy as well. Well, we've got to start with the biggest story of the day here, the August jobs report. The U.S. added fewer jobs than expected in August in the latest sign of a cooling labor market. With more on what Wall Street is making of the print, let's go ahead and bring on in Yahoo Finance markets reporter, who is the man himself, the myth and the legend, Josh Schaefer, with us here on set. All right, Josh, so what do we make of this print here?
Brad, I'm just shocked by the intro.
Flattered. I try.
Absolutely flattered.
Everybody gets a promotion when I introduction them.
So, I want to run through a little bit of what Wall Street's saying this morning, right? I was looking through some economist notes, and I'll highlight two off the top here that I think sort of sum up the tenor that we're hearing from economists this morning. So Paul Ashworth, the chief North America economist over at Capital Economics, he said overall this August jobs report is still consistent with an economy experiencing a soft landing rather than plummeting into recession. And then you flip over to what Morgan Stanley said. This is Seth Carpenter, their chief global economist. He says today's report implies recession fears may have been overdone, but confirms slowing. We retain our baseline view of 25 basis point cut from the Fed in September, but await Fed speak and the next CPI. It seems like overall economists, not seeing a lot of economists on the street right now saying this report points to 50 bips in September. But it does open that door for a 50 basis point cut at some point, as Maddie was just referencing, whether that's November or December, and you get to a total of 100 basis points of cuts at some point this year. But I thought what Seth said there was interesting. The report, since it wasn't decisive either way, right? It wasn't, oh wow, the economy is, or the labor market's significantly stronger than we really thought, or significantly weaker. It sort of leaves the debate open for what we might hear for the rest of today, potentially from the Fed, but also that CPI print next week. If you get a really strong CPI print, inflation falling more than we expect, and that picture continues to look very well, maybe there is enough in this labor report for the Fed to want to go 50, and maybe we're still sort of talking about this debate all the way leading into the report rather than it felt like today coming into it, maybe we just have an answer, right? We were going to get a firm answer, and it seems like we just simply did not get a firm answer.
That's exactly what I'm taking away from your reporting in terms of the market reaction from the likes of Seth Carpenter. It sounds like, yeah, we don't really know what the Fed is going to do with this.
Well, and I think the stock market's telling us that too, right? You guys were just talking about what the major averages are doing today. Okay, so we got a rotation out of tech, the Dow's up, and the S&P's down a little bit less than the NASDAQ. Isn't that what we've seen all week?
Right.
Right? We're still seeing very similar trading action to what you're seeing before this report, which says whatever traders and investors were feeling 3 days ago, I don't really know if they feel that different now. And maybe we just need to learn a little bit more about where things stand. I think there's other parts of economic data people have been watching too, right? You're going to get another retail sales print. How's the consumer doing? That came in better than expected last month. So there's other pieces of the story here that I think we're going to need to get more of a clear picture, which keeps our jobs fun.
Very true. And we know that Powell loves the anecdotal earnings data and things like that as a former Wall Street guy. So maybe these upcoming earnings prints are going to be important for him, but not necessarily the rest of the voting members. Josh, thanks so much for joining us. We really appreciate it. Well, stocks are mixed this morning after that a week's worth of data that sent markets seesawing, all culminating with today's jobs report. So, while markets in September mirror what we saw back in August, a burst of volatility and settling toward the end of the month, or could we be in for more choppy activity ahead? We posed this question to our strategists throughout the week. Here's what they had to say.
I think we will see continued volatility during the month of September.
I do think we're in for a period of more volatility. That's what the seasonality suggests, the worst month for the S&P 500.
I watch the VIX closely. You don't see spikes like that without aftershocks, and that's what we're seeing now.
I think we get back and test the August lows in tech. So I think you can have another 5-6% pullback in the NASDAQ 100.
Here with more on this, we've got Gary Schlossberg. He is a global market strategist at Wells Fargo. Gary, it's great to have you on here. So talk to me about the market reaction here. It seems like Wall Street is mixed on a 25 or 50 basis point cut. They didn't get the confirmation that they were necessarily looking for. What is your take?
No smoking gun. There were some soft spots in the report, but overall, I would agree that in the aggregate, when you look at some of the stronger parts to the employment report, we're still on track for a soft landing, for a mild, moderate economic slowdown. We still have data ahead. The economy clearly is winding down. I wouldn't rule out a recession at this point, but we have to see more evidence of that. And I don't think the August employment report really provided that.
And why is that, Gary?
Well, we did have the downward revisions to employment. That was a focus. Clearly, job growth is winding down. But the work week, leading indicators of employment, temp worker employment continued to decline. The declines moderated materially. The average work week was up. Overtime hours in manufacturing were up. The net of it all is that aggregate hours, the total number of hours worked by in the labor market, did actually increase on the month. Not a spectacular report, but still consistent with this steady winding down in economic growth and not falling into a recession, at least not yet.
Gary, the underemployment rate is something that I love to look at, U6. It tells us the degree to which folks are able to get the type of work that they're looking for, the number of hours that they're looking for example. It is starting to tick up. It came in just about a basis point above the prior month here. Is that something that is indicative of companies continuing to kind of pare back before they move on to something more drastic like issuing layoffs?
Yeah, I think there is a reluctance to lay workers off. We still have the after effects of that post-COVID period, labor shortages, difficulty in finding workers. We think that will temper the slowing in the job market. For now, at least, there are clear indications that the market is softening around the edges. Job openings have been declining, as you pointed out. The underemployment numbers seem to reflect a reluctance to outright lay workers off. So all this to us points toward a shallow employment cycle as we go through what we think will be a soft landing.
You know, it was really interesting, Gary, as we were breaking down the numbers earlier with RSM chief economist Bruce Whis. He was making the point about productivity and that flowing through to earnings growth for companies. I wonder how you're evaluating that and what you're seeing on the probability metric that is passing back through to what companies are actually showcasing and trying to show off that they can bring to investors, even given a wobbly type of macroeconomic outlook that they might be tracking up against.
Well, I think there will be an effort as we go through the cycle to try to squeeze more hours work out of each worker. And we will see productivity improve if the economy continues to hold up in economic growth. Longer term, we've yet to see the benefits of artificial intelligence, the digitalization of the economy, other tech advances, really not showing up yet in the productivity numbers. We expect to see that down the road. But for now, at least, over the next year or so, I would think that employers are going to hold back in hiring as the economic outlook remains unsettled. We may not see that strengthen productivity growth, but employers will do what they can to prevent productivity growth from actually rolling over.
Gary, amid that uncertainty that you're describing, where can investors kind of hide out and find a little bit of safety?
Well, there are certain defensive sectors of the market that typically hold up better as the economy is unwinding. We're looking through that. We're actually focusing on those areas of the market that are fundamentally strong, where the outlook is reasonably good. The materials sector is going through a difficult period, but we think that given the fundamental balance in the market, that should hold up well. Industrials, looking through the slowdown, financial services as the economy recovers. But the defensive part of that strategy is just focusing on quality, the ability of balance sheets, finances to hold up well as the economy goes through an unwinding. Large cap liquid stocks continuing to focus on the U.S., we think provides some protection to the investor.
Gary Schlossberg, who is the Wells Fargo Investment Institute Global Market Strategist here. Gary, thanks so much for taking the time here with us on this Friday. Appreciate it.
Thank you.
Certainly.
Thank you.
Let's take a look at some market headlines to start the hour, sponsored by Tasty Trade. Major averages, as of right now, they are mixed as we are just a little over 45 minutes into today's trading session here. We're taking a look at the S&P 500. Right now, that's down by about 0.5%. The Dow Jones Industrial Average, though, that is barely holding on to the gains by the hair of its chinny chin chin, up by about 0.1%. We'll round that off too. And then the NASDAQ Composite, yeah, that's in the red. Tech getting hit right now. It's down by about 1%. Take a look at XLK specifically here, as that is the sector that we would track typically within the S&P 500 of the 11 sectors here. And taking a look at XLK, it's down by about 1.25%, as tech is one of the hardest hit sectors on the day, as we've been tracking here on today's trading activity. Maddie, is a little bit more of that sector activity has moved into the red as opposed to what we were tracking at the start of today's trading session.
Absolutely, Brad. It's interesting to see how things are bopping around here. I want to pull up our Treasuries board so I can take a look at how the market action is looking in the Treasury space. We are seeing a little bit of a reversal. You had yields tumbling on the heels of that jobs print, and now you're seeing gains across the curve. You're looking at the 5-year, 10-year, and 30-year yield right now, seeing the biggest gains in that 10-year yield, up about 4 basis points, or 2 basis points rather. So it's interesting to see that recovery as we are starting to digest those non-farm payrolls, perhaps initially a stronger reaction than the street is willing to stick around for, and you're seeing some bond buyers coming in on the heels of that softness in yields. Having said that, I also want to take a look at the US dollar that has been under a bit of pressure over the past couple of days here, but you can see the dollar strengthening just a touch on the heels of that jobs print, perhaps because the market is pricing in a lower chance of 50 basis points to come, rather sticking with the 25 basis point cut, which would be a bullish signal for the dollar moving forward. Now, coming up, we are going to be speaking with DocuSign CEO about the company's latest earnings print, so stay tuned with us for that conversation. You're watching Catalysts. DocuSign shares moving to the upside this morning as revenue came in above Wall Street estimates. I'm joined now by DocuSign's CEO, Alan Thiegason, and our executive editor, Brian Sozzi, for more. Alan, it's great to have you on with us this morning. Really appreciate you taking the time. I do want to start, just to get it out of the way, I want to start on one of the points of contention with Wall Street from the earnings print, and that was specifically regarding the billings growth. It was a little bit pressured over the quarter here. I'm curious, what do you think was the biggest driver of that? And is that something that's bottomed out as of this quarter, or where do you see that heading?
Yeah, look, I think it was a very solid quarter for DocuSign, and I think we've now fully stabilized our current business. All the metrics point to that, including dollar net retention rate, all the operating metrics. And so we did exceed guidance on all metrics, including billings. But as you point out, we'd certainly like to see billings growth pick up. And one of the things that's we are projecting a modest recovery in the second half. And then, of course, we launched this quarter our new intelligent agreement management platform, which really is the primary vehicle for our longer term growth aspirations. And the early results were really encouraging. So we launched it to the commercial segment in North America, Canada, and Australia. And so far, early order values are up significantly. Time to close is meaningfully shorter. Win rates are higher, and the business is picking up. August was twice the size of July. So it's still very early. We haven't rolled it to all the segments and to all the geographies, but the early indicators are very positive. And so there's a very buoyant mood inside the company as a result.
Alan, what is it about this new suite of offerings that you think is allowing you to have a lot of momentum behind the business from a top line perspective now?
I think one of DocuSign's strengths is that we've had such a broad customer base. We have 1.6 million monthly paying customers of all sizes in all industries and across many geos, which gives us a tremendous base to sell into. And so the vast majority of the activity that we're seeing on intelligent agreement management is upsells to existing customers. And I think we've found something that can be instantly valuable for the broad majority of our existing customers. Everybody wants more insights into their agreements. And right now, agreements go into a deep, dark place once you've signed them. And we can instantly give you access to all the high-level data in those agreements, which is valuable for practically every function. The finance function wants to know, the sales function wants to know when their agreements are up for renewal, the purchasing department wants to know how different vendors are doing, HR wants to know. And so it's just a very ubiquitous, deeply felt need that we're tapping into, and I think are the first to address at scale. And so looks good so far, but it's still super early, and I want to emphasize that. But we're really pleased with the early results, which are tracking to our expectations.
One thing that got high marks in this quarter is your operating margins, Alan. I believe they're a record high. Take us inside the company. I mean, where are you finding efficiencies, and how have you changed the structure of the company to get those improved margins at a time where some of your new initiatives on the top line are taking some time to gain momentum?
Yeah, well, that's been a very carefully managed balance. We knew we wanted to get more efficient, and I think we've done that over the last 2 years. Just one example, our sales and marketing was in the low 40s as a percentage of revenue, and this quarter it's 30. And so just getting a lot more efficient. It's everything about our sales process, improving our self-serve capabilities, tightening things on marketing, and all of that, while making sure that we are as efficient as possible, as productive as possible. I think we've been able to do that while stabilizing the business. We feel we're right-sized now for our current business and poised for growth. Obviously, if we see profitable investments going forward, we will look for those. But right now, I feel like the company is right-sized for its current business and for the opportunity ahead, and the teams are clicking on all cylinders.
Hey, really quick quickly here, I want to get your take on the macro. It was a big day for the Federal Reserve and the macro environment. We got this jobs print that indicated kind of where the Fed may be heading next, but I feel like you could have maybe a little bit predicted what we would get out of that print because I know you work with clients across so many different sectors. Talk to me about where you are seeing growth and where you're seeing weakness in terms of the labor market. If Jay Powell was going to call you this afternoon, what would you clue him in on?
Yeah, I don't think it's going to call me, but we do. You're right. We do get a pretty broad swath of the economy. We certainly DocuSign's used for offer letters, for example, and so I suppose we get some indication there. A lot of account openings in financial services and so on. I think we're not seeing any major discontinuity. I think the economy has been heading in a decent direction. We're not projecting any further recovery. I just want to emphasize that our forecasts are based on the economy as we see it today. If there are interest rate changes, that certainly would help in, for example, our mortgage business and so on. But we're so balanced across many sectors that we're not super sensitive to that in the way that people might expect. So many people encounter us initially in real estate transactions. So I don't have a strong forecast for you, but it certainly does not feel to us like the U.S. or the major international markets that we're operating in are heading into deep recession.
Right. I know you had a lot of international growth over the quarter too, so that's something hopefully next quarter when you come back, we can talk a bit more about. Alan, thank you so much. Alan Thiegason joining us, CEO with DocuSign, and of course our very own Brian Sozzi for bringing us the conversation. Thanks so much.
Thank you both for having me.
We're going to have all of your markets action ahead right here on Yahoo Finance, so stay tuned for more. You're watching Catalysts. Let's get to some of our top trending tickers. And throughout the trading day, you can track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. You can scan this QR code right below on your screen to check out the latest. Let's get to it though with ASML under pressure today after the Dutch government announced increased export controls on advanced chip manufacturing equipment, citing national security concerns. Also, shares are down as Morgan Stanley removing ASML from its top AI pick list. This is something that is critically watched on the street as an indication, particularly of where stocks within the semiconductor sector are heading. Now, the brokerage did maintain their overweight rating on ASML, but they lowered the price target slightly, and they kind of assessed the business and looked at it as a potential slowdown to come, just in terms of the growth story. And Brad, I think that's something that's been a theme across several of these chips names, not only the news with the Netherlands in terms of the export controls, but also can the growth story keep up? And I think that's something that put Broadcom under pressure in their earnings, and certainly was the same story with Nvidia as well.
Yeah, so for ASML, I'm going to approach this from a little bit of a different perspective here, and perhaps we can throw up a longer term chart for them, maybe a 1 year or a year to date. Either one of them will do. We're not quite at some of the year to date lows for this company. We still have a ways to go to get to that point. As you can see, that's where you saw that kind of red territory early on in the year where the company was in decline. So we're not quite there yet, but here's why I bring this up. There's some support that this company might retest at this level, even in this longer term higher trend that we've seen. And so even if they were to set a higher low here, that is going to be the larger question as to whether or not they can bounce off of that support and continue to kind of regain some strength here. Now, what you were mentioning is more key in the entrenchment that the Dutch government is looking for some of the intellectual property stemming from companies that operate in its region here. So something for both the technical traders and for the moat traders out there as well.
Well said though, Brad. That's a really good point in terms of the fundamental piece there as well.
Yeah. Try. Oh, yeah, this one's me. Oh, we've got our eyes on Apple ahead of the company's big event next week. Customers are hoping to get a glimpse of the new iPhone 16. Here with what we can expect and me, because I need a new iPhone. Once the event kicks off Monday, is our very own Dan Halley, who has told me that I need a new iPhone. He has reminded me of this vehemently. All right, Dan, what are we going to be tracking?
Yeah, Brad, this might be the one to upgrade for. If not, maybe next year, but I guess if you follow that thinking, then you'd never upgrade. But what we're expecting for the iPhone 16 are really some minor upgrades on the hardware side of things. This is all about getting consumers prepped for Apple Intelligence, Apple's AI platform, their Gen AI platform that they're rolling out. That's going to be something that, according to Bloomberg's Mark Gurman, won't be available, at least in its entirety, right out of the gate when you get your iPhone. It should be rolling out as a series of software updates in October and then more to come later in 2025. But as for the phones themselves, we're going to have the standard iPhone and iPhone 16 Plus, and then we will likely get the iPhone Pro and iPhone Pro Max. The Pro and Pro Max may have slightly larger displays. Not that the footprint of the phone is actually getting bigger. You're not going to have a chunkier phone in your pocket. Rather, the display technology is going to allow them to kind of stretch the borders out a little bit further and slim those bezels down. So a little bit more screen real estate. It's probably not going to, knock your socks off from afar, but you will notice it if you're upgrading from an earlier phone. There's supposed to be a new physical capture button on the side of the phone. This is likely for using it as a camera more easily, kind of really trying to kill off the point and shoot, although I have seen more people picking those up lately, kind of that retro tech trend that's going on. And then outside of the iPhones, well, there's also the processors. I just want to touch on that real quick, because if you have an iPhone 15, regular or Plus, you're not going to be able to use Apple Intelligence. If you have an iPhone 15 Pro or Pro Max, you can. It's because of that processor. So they'll have new processors in both phones, both lineups. So hopefully that means all of them will be able to run Apple Intelligence. But outside of that, we're expecting new Apple Watches. This is the 10th anniversary of the Apple Watch's debut. I know it's very strange to say that, 10 years that Apple's been talking about that. They're going to reportedly get larger displays and thinner body. So instead of the 41 and 45 millimeter, it'll be 45 millimeter and 49 millimeters on the displays. Apple isn't really one to go too far and make them, unwieldy for people with smaller wrists. Samsung has a giant watch that just doesn't fit on folks who have small wrists. It just looks bonkers. So don't expect the 45 millimeter to be, this gigantic piece of statement jewelry or technology. It'll probably still look just as good on smaller wrists as well. And then there's going to be new AirPods. They're going to revamp the kind of entry-level and mid-tier AirPods. Expect them to have newer designs, anti-sound dampening, so sound dampening technology, active noise cancellation in the mid-range version. The entry-level version won't have active noise canceling, but the pricing will still stay the same, likely at $129 and $169. And then the Pros are just going to stay the Pros as they are. So don't expect any silicon tip replacements for the mid-range and the entry level. That's going to stick with the Pro models.
All right, Dan Halley, thanks so much for joining us. And I know we will be covering that event for us on September 9th, so we'll be talking with you more. Appreciate it. Another Magnificent Seven name we've got in focus today, Alphabet, facing the feds once again on the heels of a loss against the Justice Department last month. A judge ruled Google had abused its search engine monopoly. Now Google heads into another antitrust trial, this time over its suite of ad tech businesses. Yahoo Finance's Alexis Keenan is here to explain what's at stake for the company moving forward. So Alexis, it's interesting. This is just the latest in terms of Justice Department news that we've gotten about these big tech names. What stands out to you?
What stands out is this is the second time Google is going to defend itself in a major antitrust trial against the U.S. government, against a group of states. In this case, it's 17 separate states are joining the Justice Department to say that Google is illegally monopolizing 3 different advertising technology markets. And the way to understand these markets is to look at the different categories. Okay, one is ad servers, and that is the market that Google owns businesses, has developed its own businesses, has purchased its own business, purchased other businesses, other market leaders. On the publisher side, this is where publishers, website owners go in order to post the inventory of advertising space that they have available for buyers to buy. The other side is, the other silo is Google's control of the advertising side, the functionality, the technology that advertisers use to go and find those ads. Also, the exchange that is used for those parties to meet in the middle and make a deal. So the government, the states, they don't like that Google is on all sides of these transactions. They say that that inflates prices, that it stifles innovation, and that's why it's an antitrust claim. Now, this, of course, is on the heels of a defeat just about a month ago by the Justice Department. Google has suffered a defeat and been called a monopolist, an illegal monopolist in the search category. It's bread and butter. Now, certainly this ad tech suite of businesses, it is not as big of a revenue driver for Google like searches. Search represents some 90% of Google's annual revenues. If you take a look at these ad tech businesses, though, they're still really integral to Alphabet, to Google, because they're interoperable, right? They help fuel search. Search helps fuel these companies. So in 2020, these are the numbers that we have because Google disclosed some of these figures that are attributable to the ad tech business in court documents. In 2020, these ad tech businesses accounted for $20 billion of revenue for Google, $1 billion in operating profit in that case, roughly 11% of gross revenues, 2.6% of operating profit at that time. Now, today, Wedbush analysts estimate that that number has dropped a little bit, that it's more like 2% of Google's operating profits today if we were to scale up those numbers to 2024. So when you compare that to search's 90% of revenues for Google, very different figures here, but we cannot ignore the fact that these businesses work together. Now, the problem, though, is if Google fails, if they're defeated ultimately on appeal, right? They've said they will appeal the search case. If they lose on any level in this case, any part of this case, certainly we would expect them to go through long appeals. The problem is not necessarily the loss itself. The problem is the follow-on suits if they are deemed a monopolist, because then that opens the door for other companies to come and say, I have this ticket. It says you monopolize this category, this market, and now I'm going to sue you to try to get back those ill-begotten gains. One instance is Yelp. They've already sued Google on the heels of the search loss. So a lot to come still here. This could go on for years, but these are major risks for Google, as big as as Google is and as dominant as it is.
Really good overview there, Alexis, and really important point just in terms of the read through and the timeline here and how that could impact the company moving forward. You never want to be bogged down in legal issues. So
That's
really
for sure.
appreciate you
Yeah.
making time for us there. Really appreciate it. Alexis Keenan, thanks so much. We're going to have all of your markets action ahead right here on Yahoo Finance. You're looking at a significant move to the downside across the major averages. We'll continue to cover the market action when we come back.
Chevron announcing plans to boost oil and natural gas recovery at 2 of its facilities in the U.S. Gulf of Mexico. Here with more, we've got the vice chair of Chevron here with us in studio. Great to have Mark Nelson. Mark, thanks so much for taking the time here with Yahoo Finance.
Brad, it's great to be here.
Absolutely.
Thanks for having me.
Yeah, let's dive into this. I mean, what really prompted this decision? Like, just give us the lay of the land of the oil and gas market right now, the energy sector more broadly, especially as, I mean, we're speaking and we're seeing some of the new lows in Brent crude here and now.
Yeah, I think the first thing I would say is that oil demand remains strong.
Yeah.
So across the globe, people need this for their energy today, right? It's a growing world. They need energy. Some of our recent announcement about the Gulf of Mexico talk about what can be done, what's possible in this space. And the Gulf of Mexico is one of those areas where we have some of the lowest carbon barrels of oil available to the world. And we've made some recent announcement that I think would make people excited if they understood the technology and what it unlocks for the future.
When you think of the marker that I just mentioned ago, and just to put a fine point on that, we're hitting for 2024 the lows of crude oil here on the day. What are some of the biggest factors driving this market right now?
Well, from a macro standpoint, I think you see two things. I think you see demand coming back to traditional growth levels. So coming out of the pandemic, there was a bit of an extra boost. Everybody kind of catching up on their travel and markets coming back to normal. Now we're seeing about that 1% to 2% oil growth, demand growth that we've traditionally seen. So I think that's happening. And then you see uncertainty in the market. You see OPEC and OPEC Plus to some degree controlling supply and questions about geopolitics. This kind of keep us in a range, but keep us bouncing around.
How much should investors in this market right now, and not saying that you should put the investment strategist hat on, but investors out there trying to figure out what type of shock that could put to the system if you did have OPEC decide to make a snap decision one direction or the other, and right now it's been about more production, inserting more production into the system.
Yeah, I think you would expect OPEC Plus to, and I can't speak for them, but I would expect them to stay disciplined over time. Now, there's boundary conditions, I suspect, within which they can operate there. But if you think of oil demand growth coming into normal ranges, and you think about supply opportunities that exist across the world, the most competitive barrels will compete, and they probably need to keep prices in the ranges that we're seeing in the last year or so. So range bound between this low of today and maybe the $70, $75 a barrel range.
A lot of people who've been tracking the ticker symbol for years of CVX on the Yahoo Finance platform, they know about some of the acquisitions that you've made over the years, that the board of directors and the leadership team have really discussed at length. One of the most recent ones is, of course, Hess. That's a bit delayed, it seems, here until 2025. You know, what does that mean in terms of the other growth opportunities and the levers that you believe Chevron is still able to pull right now?
Brad, you may remember when we announced the Hess deal, we talked about, we don't have to do this deal. We're doing this deal because it's so good for both companies. One of the reasons we didn't have to do the deal was because we had a growth profile existing in our corporation. In fact, we have free cash flow growth that's in the 10% range over the next 3 years. It's really exciting for our investors, and that's driven by a portfolio that has growth built in. So the Deepwater Gulf of Mexico, we're going to hit our million barrels a day in our Tengiz operation, another exciting opportunity. So when you think about those type of things coming, there's a lot to be excited about in the short term for Chevron. Long term, we also have our Eastern Mediterranean, we have our Argentina portfolio that's very strong, and we're growing our petrochemical business as well. And so there's a growth trajectory with or without the Hess transaction, but we believe the Hess transaction is good for both shareholders.
What do you think that next big investment is, whether it be an acquisition or whether it be an investment into a region like we'd seen previously be announced with India as well recently? Where are those ripe opportunities that you're discussing at the board level right now?
Well, I think what's nice about our portfolio today is it doesn't require the massive investment. This is a more stable investment profile that we have for our portfolio today, so we can add growth in the Gulf of Mexico that are in a gross spend or in the $5 billion per action type of activity. So that's one type of scale. We have the growth that exists in our Permian portfolio that's a factory, where we're drilling wells and completing them on an ongoing basis. So it de-risks the investment profile over the whole operation. So you don't have to look for one big opportunity. You can consider the big opportunities against these smaller plays that are highly economic.
Oil and gas always gets brought back into the conversation. It seems like every election cycle as well here. When you hear about the rhetoric and hoping that your own company doesn't get pulled into the political stages and debates, how do you ultimately position the company for navigating whatever plays out on the political landscape, both here in the U.S. and more broadly as well?
Well, our strategy has remained abundantly clear, I think, to all parties. We clearly believe the future of energy is lower carbon, and that we want to leverage our strengths in participating in that. So regardless of who wins, we don't participate in the presidential elections. We try to provide information to current administrations or potential administrations in regard to how we think about the energy industry so that policies balance economies as well as energy needs over time.
Is there a policy that you could see coming forward that helps with that furthering of clean energy transitions as well?
I could say there's an area of opportunity, regardless of who is in office, regardless of whether you need more of today's energy or want to enable tomorrow's energy, and it's permitting.
Absolutely. Great to have you here with us in studio. Mark Nelson, who's the vice chairman of Chevron. Great to have this conversation. Thanks, Brad. Absolutely. Thanks so much. All right, appreciate Mark Nelson for taking the time with Yahoo Finance. Everyone, we want to give you a quick check on the markets here as the sell-off has intensified. Of course, we had looked at some waffling and early trading activity among the major averages, but as of right now, just a little under 90 minutes into trade, we're taking a look at the S&P 500, the Dow, and the NASDAQ in declines here. The S&P 500 in decline by more than 1.2%. The NASDAQ is lower by nearly 2% here. Let's also check in on Treasury yields. They are lower on the short end of the spectrum here as we've been tracking that, but you're seeing some declines across the 5, the 10, and the 30 here. This is coming off of the back, of course, of the employment situation, the August jobs report, which was weaker than expected on the headline non-farm payroll number, 142,000 jobs added versus the 165,000 that were expected. unemployment rate that came in largely in line with expectations, slight tick lower. However, the market now really trying to figure out what this sets up for September and if the Fed is further behind the 8 ball than anticipated here. And so will there be a snap 50 basis point cut decision? That is what the market is jousting with right now. And that's starting to play out in equities just a little bit more, to the tune of thinking that the Fed may be a little bit further behind and needed to perhaps cut earlier than September. As we were discussing with Jay Woods of Freedom Capital Markets yesterday, he was in that camp. Seems some others may have been as well here. And I want to zero in on the sector activity that we're seeing. All 11 S&P 500 sectors are in negative territory right now. Take a look at technology, the biggest decliner as of right now. There have been a few big earnings reports to come out to really give us a little bit more indication about where risk on might be turned off right now. And so some of those riskier areas of the market, you might see some slippage, and technology right now, which typically is a beneficiary of easy money policies, you're seeing that in decline right now by 2.3%, the biggest decliner here early in trade. And then additionally here, I'll just take a quick look at crypto. As we were talking about some of those riskier assets, you're seeing declines in Bitcoin by about 3.4%, declines across the board in cryptocurrencies as of right now. We'll continue to track this as the market activity goes on. We've got much more here on Catalysts after the break.
Welcome back to Yahoo Finance Live. I'm Brooke DePalma, joining you from the Goldman Sachs Global Retailing Conference. I'm joined by Goldman Sachs U.S. retail analyst Kate McShane. Kate, thanks so much for joining us.
Thanks for having me.
In a few words, break down what we're seeing amongst the U.S. consumer right now.
The words we actually heard were steady, choiceful, value-seeking. That's the consumer.
And do you think spending will pick up in the later half of 2024 and into 2025? What are some of the challenges that consumers are still facing?
Well, I think the election has to be noted as, at least at a minimum, a distraction. We've seen that in the past influence sales. I think also there's 5 less shopping days this year between Thanksgiving being a little bit later. Christmas is always on the 25th, but there's 5 less shopping days. So those are 2 actually big challenges the retailers face versus maybe last holiday season.
What are you hearing among consumers ahead of the U.S. election about potential tariffs?
So there is one candidate that prefers tariffs more than another. If there were to be tariffs, I think it would be inflationary for most retailers. And so in the past, what we've seen from tariffs is that prices go up.
Are you expecting retailers to increase their prices? What are you hearing?
So no one will really commit because it's only a scenario for right now, but I think if the tariffs were any indication from 2018, 2019, we did see prices go up the last time. I would imagine we'd see some price increase this time as well.
I want to hit on what we're hearing from big box retailers. We heard from Walmart do really well with their low price strategy, and then following Target's results where they lowered prices on 5,000 goods, they seem to do well. What is the difference right now between value and the actual price of things, and what are consumers favoring right now? Is it that value play, or is it the actual cost of goods?
Yeah, it's a great question. I think there is a lot of emphasis on value no matter what strata you are in terms of demographic. But where I do think it's price is the lower income consumer, because frankly, prices are still high when you look at where prices were just a couple of years ago. There's a compounding effect to inflation, and those lower income consumers that don't have a lot of dollars to play with are still very stretched. So I think they're looking more for price versus the value.
We did hear from Dollar General, Dollar Tree, and it was disappointing results.
Yes.
Shouldn't dollar stores do well in this sort of environment? Why are we seeing this?
Yes, it's a little hard to say they should be doing well. The way Dollar General explained it to us is that they do cater to a much lower income consumer, $30,000 and below, 60% of their business. That consumer is still shopping with them, but they're very stretched. Their 3 weakest months in the quarter were the last week of each month, which shows that the consumer doesn't have enough money to keep purchasing through the end of the month. And so that was a big change from what they saw in the first quarter. And they're not yet seeing that middle income consumer trade down or spend more with them.
And they did introduce that multi-tier option. Do you think that that's not necessarily working in their favor the way that they anticipated?
Well, they still do have a dollar price point. It's about 20% of their goods that they offer is at $1. So they still convey quite a bit of, again, value, and that dollar price point is important to their lower income consumer.
Looking out to the holiday, what sort of environment are we seeing when it comes to promotions and value offerings? Can we expect more than in years past?
I think what most companies told us over the second quarter and today is that we should maybe expect a little bit more versus last year. It's going to depend on the retailer, it's going to depend on the category, but we do think, again, the consumer is looking for, again, value, promotions, and we could see a little bit more year over year.
I do want to quickly hit on the home improvement retailer. It seems like lots is waiting on the potential of an interest rate cut. What are you hearing from Home Depot, from Lowe's, that indicates what the back half of the year could look like?
Yes, I think housing turnover has been a real headwind for both Home Depot and Lowe's, and until you do see some unlock and interest rates and mortgage rates come down, that housing turnover number is going to continue to be soft. And housing turnover isn't necessarily what drives sales at Home Depot and Lowe's. It's actually home price appreciation and private fixed residential investment. But housing turnover is so depressed that until that unlocks, will you see any kind of improvement at Home Depot and Lowe's.
Taking a step back, what are 3 of the biggest challenges that consumers face right now, heading in, not only taking into consideration the U.S. election, the holidays, but really looking into 2025? What do you think will still remain sticky then?
Well, I think the good news is that our outlook is that the labor market is still very strong and you still are seeing wage growth. So we do expect the consumer to still be employed and still be making more money. I think also in addition to that, you do have costs coming off a little bit, and if there were to be interest rates cuts, you would have less financing obligations as well. So we just put out a discretionary cash flow analysis that actually shows the consumer should have more cash in 2025 than they did in 24. But potential headwinds, of course, is the stickiness of inflation and the higher prices, which I do think continues to stretch people's wallet.
Kate McShane, U.S. retail analyst for Goldman Sachs. Thank you so much for joining us.
Thank you for having me.
Our thanks to our very own Brooke DePalma for bringing us that conversation. Now, coming up, you've got Wealth. It's dedicated to all your personal finance needs. And Brad Smith, he's going to stick around with you right here for the next hour. So stay tuned and have a great weekend.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks to grow your money. Hey, on today's show, digging into that August jobs report. What happened? What are the implications for the labor market and for you and your job hunt? We got all that. Plus, how to have the great wealth talk ahead of the great wealth transfer. We'll give you tips to have that sometimes difficult conversation around that kitchen table. Plus, Debt Consolidation 101. An expert will teach us about the benefits, drawbacks, and methods that you can deploy to consolidate debt. We've got all that and much more. But first, we have a fresh commentary and read out from the Fed ahead of their blackout period, which begins at the end of the day, 10 days before their September FOMC meeting. Here with more, let's bring in Yahoo Finance's Fed correspondent, Jennifer Schonberger. Hey, Jennifer, what are we hearing?
Good morning, Brad. We're just hearing from Fed Governor Chris Waller, who says the time has come to cut interest rates at the next policy meeting. It doesn't get any more clear than that. Those comments being made in a speech entitled "The Time Has Come" at the University of Notre Dame, where he also talks about the jobs report, saying that the August jobs report supports the story of an ongoing moderation in the labor market. He says, quote, Today's jobs report continues the longer-term pattern of a softening of the labor market that is consistent with moderate growth in economic activity. Waller said that while the labor market has clearly cooled based on the evidence he sees, he does not believe the economy is in recession or necessarily headed for one soon. He says, though, to maintain the economy's growth, the Fed needs to cut rates. He sees a series of rate cuts, noting that if subsequent data shows significant deterioration in the job market, the Fed can act, quote, quickly and forcefully to cut rates. He says he's open-minded about the size and pace of cuts based on the data. And if the data support cuts at consecutive meetings, he is for that. He says if the data supports cuts, the need for larger cuts, he's also in favor of that. And Brad, he also said he was in favor of front-loading rate hikes when inflation spiked back in 2022. And if needed, he would be in favor of front-loading large rate cuts if appropriate. Back to you.
Jennifer, thanks so much for that roundup. Really appreciate it. Of course, a lot to track going into that September meeting for the FOMC. But first, let's take a look at some of the market action here. 90 minutes into the trading day, as we are taking a look at a sell-off right now. The NASDAQ is down by about 1.8%. It was down more than 2% not too long ago, so a little bit of a pullback. However, you're still seeing all major averages in the red right now. The Dow is down 0.3%. The S&P 500 down 1%. Stocks are off of the session lows. The U.S. economy added fewer jobs than expected during the August month here that was tracked, while the unemployment rate ticked lower. Friday's report comes amid an ongoing debate over how severely the Fed should cut interest rates at its meeting later this month. For more on what the latest data means for you and your portfolio, we've got Lydia Bussour, who is EY's senior economist here. Lydia, great to have you here on the program with us. So what does this signal to you about the type or the depth of a cut that we could get or see from the FOMC?
Yeah, so the jobs report this morning essentially showed that the labor market is gradually softening, but is not falling off a cliff. So, you had moderate growth in payrolls. You had that slight decline in the unemployment rate. You also had the rebound in hours worked. All of these factors point to a labor market that's gradually softening. So, you didn't see the type of broad labor market deterioration that would have led the Federal Reserve to potentially implement a 50 basis point rate cut. So in terms of the size of the rate cuts, we remain in the camp that the Federal Reserve will implement a 25 basis point rate cut and will opt for that gradual approach with a steady pace of decreases throughout the remainder of the year. So three 25 basis point rate cuts by the end of the year.
So what does that set up for what the terminal rate as they get into that cutting cycle could look like here?
Yeah, there is a lot of uncertainty surrounding the pace of rate cuts as we head into 2025. As you know, we have the elections and a lot of uncertainty in terms of the post-election landscape. Right now, given our baseline for economic growth to fall below trend in the coming quarters and then gradually rebound in 2025, given our expectations for the disinflationary backdrop to continue and given our expectations for the labor market to soften but not deteriorate materially and fall into a deeper downturn, we're expecting 125 basis point of rate cut next year and a continued moderation, towards a little bit below 3% for the terminal rate. But there is a lot of uncertainty surrounding the pace of this easing cycle as we head into 2025.
Just lastly, while we have you here, Lydia, one of the other, of course, major data points that the Fed looks at is inflation and their dual mandate. And we're going to get CPI out next week. At what type of weighting, essentially, do you believe that the Fed is giving employment versus inflation at this juncture?
I think inflation and the inflation readings that we're going to get are going to be important, but it's also important to take a step back from these, all these data points and really look at the overall backdrop. If we look at the overall inflation picture, we've seen a lot of progress on the inflation front, and we remain in a disinflation environment when we look at this labor market that has rebalanced, when we look at final demand that has slowed as well, and more disinflation coming on the housing front as well. So all of these, disinflationary factors are going to keep inflation, we think, on that disinflation trend. So really the focus right now is more on the labor market, in my view, even though Fed policymakers are going to continue monitoring the inflation data. But overall, given the fact that the economy is still advancing at a modest to moderate pace, around 2%, given that inflation has moderated significantly and that the risk to the labor market outlook has increased, I think we're all set for that 25 basis point rate cut and that gradual pace of easing going forward.
Lydia Boussor, who is the senior economist at EY. Thank you so much for taking the time here today. We appreciate it.
Thank you.
Certainly. Coming up, everyone, with the return of volatility to markets and an upcoming Fed rate cut anticipated, how can consumers curb emotional selling? We break it down next. Something families aren't doing enough is talking about the great wealth transfer from the heads of a family to their children and grandchildren as well. That according to a finding from Edward Jones. Joining us now, we've got Lena Haas, who is the Edward Jones Principal and Head of Wealth Management Advice and Solutions. Great to have you here in studio with us.
Great to be here.
Okay, so you say families are not talking about this enough. Where does the conversation, where does the dialogue need to begin?
Yeah, so it was astounding to me to learn that over 50% of folks in the US will be affected by wealth transfer. They're receiving inheritance of some kind. Mm-hmm. And yet, despite that, the conversations are really not happening across family members. And wealth transfer is inherently an emotional and a complex topic. And we think that's why.
How do you think this can change or will change the makeup of what's our demographics look like in terms of the population and the wealth metrics that we track up against right now? You know, how does this change ultimately the type of investing that we could see come forward, the property owners, and so many different kind of facets of people's portfolios too?
Yeah, so first of all, over the next 2 decades, we expect 84 trillion to change hands between the older generation, silent generation, and the baby boomers, and the younger generations. And then the immediate wealth transfer oftentimes goes from a spouse who is male to a woman partner, because typically there is a difference in longevity and about 6 years age difference. So it oftentimes is going to go in terms of women having much higher percentage of wealth. And of course, the younger generation figuring out how do they manage this wealth, engage for the long term, and do it with sound investment principles, but also keeping up with the family legacy, family values, which is why it is so important that conversations are happening across generations, that parents are in fact talking to kids about what to do with that money and why.
Those family values and even the investment thesis can change generation to generation as well.
Absolutely.
Here. And there's a lot of emotions at stake too. How do you remove emotion and prioritize securitization of the wealth that families build up?
Yeah, that's such a great question. So don't have this conversation around Thanksgiving, dinner table by surprise. It's really important to prepare everybody in the conversation that this is what we're going to talk about. This is why, how do we invite the right family members? And about 60% of Americans say that having a financial professional, such as an advisor, can really help take emotion out of this inherently, the heart, the head, complex conversation.
So just invite the financial advisor to Thanksgiving as well. That's what we should just do that.
That's right. But in addition to eating the turkey, financial advisor will come and they'll prepare the agenda, what are the right points to hit on. They can bring in professionals such as estate planners, accountants, others, and they can really facilitate the conversation that when the wealth transfer does occur, the emotional event, somebody passes on the family members can be there for each other.
Excellent.
They don't need to focus on the logistics, a professional can.
Yeah. Lena Haas, Edward Jones, thanks so much for taking the time here with us today. Removing some of the emotion from the great wealth transfer. There will be a lot of it, but we can do it smartly here. Thanks so much.
Thank you.
Absolutely. Stocks have been seesawing over the last month, falling to start August, rebounding, then falling again to start the month of September. And these moves are causing some anxiety among investors. So, how are retirement portfolios faring amid the recent volatility? Here with some insight, we've got our very own Carrie Hannon. I mean, Carrie, I imagine people need to just kind of lean into what Aaron Rodgers said seasons ago, which is everybody just relax. But maybe something different. You tell us.
No, I'm with you, Brad. It's stay the course. And especially for retirement accounts, these are long haul savings accounts. But the fact is, people do get jittery. It is human nature. No one wants to see their accounts tanking, right? So they immediately jump in and try to control something. And so they sell. I looked at this new index that came out this week from the Alight Savings, their savings solutions. Alight Solutions is a 401k index. They looked at the month of August. And on August 5th, just for example, when the market went zooming down, right? Traders in their 401k accounts, investors were trading their in and out at 8 times the daily average they normally do. And what they were doing is these 401k plan participants were moving their money, this won't surprise you, Brad, from company stock, from U.S. equity funds, large equity funds, and target date funds, which kind of surprised me a little bit, which I'll explain them quickly in a second. And they're moving that money into stable value funds, into bonds, and into money market funds. They were fleeing to safety, as we say. And, this is just, okay, it's all right. I understand the anxiety. Better to wait, like you said at the top, to things chill out a little bit. If it makes you super nervous, the stock market shifts. It's part of investing. If it makes you nervous, take the time when things quiet down to look at your asset allocation and rebalance. Financial advisors usually say, if it's 7 to 10% away from what you had allocated for stocks versus bonds, that percentage that makes you comfortable based on your age and your risk tolerance, then make some changes then. But there's no way you can, people just can't market time. Who knows the best time to get in, the best time to get out? So your best advice is really just to be patient when things calm down, because after that August 5th event, guess what happened? Stocks rebounded a few days later. So those who got out missed that whole run up back up again. So, I mean, those are sort of basic advice, but it's really, and one other quick thing, Brad, I will say that if you're investing in a 401k, you're investing on a regular basis. So you are already buying when the market is low, when the market is high. So it evens out over time.
Carrie, I thought that was real money behind you for a second. I get excited. Excellent insights and tips as always here, always flowing with the money insights, our own Carrie Hannon. Thanks so much, Carrie.
Thanks, Brad.
Much more on wealth after the break, everyone. You're watching Yahoo Finance. According to Bankrate, half of American credit card holders carry a balance month to month. And although there's not a one-size-fits-all solution to paying down debt, we want to talk about one particular method, debt consolidation. Here with more, we've got David Kimball, who is the CEO of Prosper, a peer-to-peer lending platform that offers products like home improvement and medical loans, as well as, of course, debt consolidation loans. David, great to have you here with us. So what are some of the reasons for consolidating debt?
I think the biggest reason is you have higher interest rates. So you mentioned earlier, a number of people have card balances, and those typically have higher interest rate costs. And so you're looking for a way to reduce those interest rate costs, real money to you. And so typically when you're looking at a debt consolidation loan, you're moving from these higher interest rate loans to something that is typically going to be lower interest rate loans. So that's the biggest motivation there. It's a way to reduce that cost. And then a lot of times then with credit card loans, you are on a revolving basis. So you're really perpetually paying. A debt consolidation loan puts you on an amortizing loan, and it puts you in a place where you are over a period of anywhere from 2 to 5 to 6 to 7 years paying down that loan so that you get to a balance of zero instead of having perpetually that balance outstanding.
So give us the benefits and drawbacks of debt consolidation that people need to keep in mind.
Well, the first thing I would say is what you have to do is you've got to face your finances. And so on the one hand, people would say that's a drawback, I don't want to do it, but it really is a benefit. You've got to take a look at the existing loans that you have outstanding. You need to understand the terms of those loans. You need to understand how much you've got outstanding. You need to understand what you're paying in terms of fees and what you're paying in terms of interest rates. Once you have that knowledge base, then it's time for you to take a look at what are the other options for me. And so If you take a look at a debt consolidation loan, you can find something with a lower interest rate. You're going to find something, again, if you're comparing the total fees and the total interest rate of that debt consolidation loan to the information that you already have on your existing loans, you're then doing a comparison between those two. If you're able to find then a debt consolidation loan that has a lower interest rate, one of the drawbacks may be that you're actually paying more principal balance over time. So if you're short on cash flow, you have to come up with more money up front. But ultimately what that's doing is it's creating a pro. The pro is you're reducing your absolute cost. So it really comes down to whether or not you have the capacity. And ultimately, if you don't change your habits, if you keep spending the way you were spending, you're going to take the stuff from your credit card, put it on a debt consolidation loan, your credit card balance or your credit card lines are still open. If you begin to spend on your credit card lines again, what you're doing at that point is creating more debt. That's also a drawback. So really, you need to face your finances, you need to understand them, you need to make a budget, and for some people, you're gonna have to change your spending behavior for this to be a really effective tool.
All right, a lot of people's ears are burning, their heart might be on fire right now, so let's give them some active tips about consolidating debt here. Where can they begin?
Well, the first thing you can do is take a look and go online, look for debt consolidation loans. There are places like our website at prosper.com. You can look at our blog and take a look at just quick financial help items on our blog. You can look at Investopedia. You can look at a number of those places to understand really what I'm getting into. When you look at that, you can do a pre-approval. So you can apply for a loan without actually affecting your credit. Take a look at that, what that cost is, so you can determine whether or not it's right for you. So I'd say take a look and look at blogs, look at information sources so you can really understand the process here. Once again, understand your existing finances. Do a pre-approval. Take a look at whether or not what you have on the one side is going to be better on the other side by comparing my existing to what the future could be. Once you feel comfortable with that, then go for it.
And David, we got to leave things there on the day. There's so much more that we could discuss with this. We got to have you back to continue the conversation. David Kimball, who is the CEO of Prosper. Thanks so much.
Thank you very much.
Certainly. Now, speaking of paying off debt, Americans are reportedly spending more on sports betting than on investing. Joining us to discuss, we've got Yahoo Finance contributor Ross Mack here. I'm not even going to ask you what parlays you have set up for this weekend, but why do you think this is happening?
Well, one, it's a legalized high, right? I think when it's all said and done, last year, people spent $120 billion when it came to actually betting on sports. And I think the idea of almost hitting something, right? The idea of saying, oh, I can turn $10 into $150,000. And what people need to realize is that anytime you see that on social media, oh, this person hit a parlay, all they're doing is trying to sucker you in, right? Like, that's literally marketing 101, trying to show you that you could actually, it's the lotto, right? You could turn $5 into $100,000. And I think when it's all said and done, you have to look and say, okay, why am I spending more money sports betting as opposed to actually investing? I think because when it's all said and done, you look and say right now 120 billion was spent last year. This year is expected to be $150 billion. And I'm one of the same people, right? I did a little bit of sports betting. I'm in 3 fantasy leagues.
Oh, wow.
So I follow the sports, right? However, I think you need to realize if you're going to sports bet, you have to do everything responsibly, right? And that being said, I think if you say to yourself, oh, I'm just going to bet $5 every day, guess what? That actually compounds, right? Because that could be actually $150 actually invested into the stock market, and you look 3 years or 30 years from now, guess what? That's over $500,000 just compounded. And so you got to ask yourself, are you doing this responsibly, or are you a person that's actually doing it irresponsibly? You're getting suckered in, trying to get rich quick, and that's never the game.
I'm going to stop calling my fantasy football leagues sports betting for myself because essentially with the losses that I've racked up, it's a philanthropic effort at this juncture. Ross, thanks so much. Appreciate the time. As always, thank you. And you can find more Ross Mack on his podcast, Financial Freestyle. Whether you're a professional on Wall Street, a first-time investor, or someone just looking to change their financial situation, there's always a first step. Look out for new episodes every Monday, wherever you get your podcasts at. Well, coming up, we've got another episode of Stocks in Translation. Yahoo Finance's Gerard Blickery is joined by the Bid.com owner, Kenny Glick. You don't want to miss that.
Welcome to Stocks in Translation. I'm your host, Gerard Blickery, and with me is the voice of the people, Sydney Freed. Thank you for tuning in. First, a couple of conversation notes here. Be sure to like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, YouTube, or wherever you get the podcast. And today we are welcoming back Kenny Glick, the owner of HitTheBid.com. Kenny is a master of technicals, especially VWAP and anchored VWAP. And today's theme is reversals and rocket ships. We're in the midst of the greatest volatility shock recovery on record. And why rocket ships? Kenny's going to tell us, I'm sure. And the phrase of the day is mean reversion, what that means for traders and investors, as well as its opposite, which is a trend. And this episode brought to you by the number 59. That's the percentage of respondents in a new investing survey who said they are likely to use AI to make trading decisions. Exactly who is responding to the AI clarion call? Now let's get down to brass tacks. Kenny, you are a short-term trader. We have had a lot of action this summer, but also recently, VIX sprung a leak and blasted off to 65. The yen carry trade imploded. How are you? Are you capitalizing on this? Are you minting money?
Well, to be honest with you, I was up for about 72 hours when that moment was happening because I'm a short vol trader. So I was looking death in the eye. It was pretty frightening, but I also knew that it's always a temporary moment. So when I was watching the VIX do something, and I hate that word unprecedented when you're just waiting for the market to open up, unprecedented event, I was waiting for UVXY to open up, and that's what I was short. So I had to go out and start battling for my life that Monday, Tuesday, Wednesday. So yeah, it was pretty wild.
Were you fearful? You were excited? Like what went through your head when you saw the VIX make
the most frightening moment I've had in 20 years. No joke.
Wow.
Yeah, because I'm a short vol trader. I had what we call naked calls. Not what I do. This was like, it's almost like a side project that went horribly wrong.
So you say naked calls. You were selling them. You were betting that the market would never go to those levels, but then it did.
Right. And the thing is, for 12 years, I'm taking people's bets, and they're all losing. So I'm the bookie. And on that night, I had to pay out. And I was on the other side of a 20-1 and a 40-1 trade. So it kind of hurt.
Did Volmageddon get you? Because that was a big one that hurt a few years ago.
That one was a good one. That one I was on the right side.
Because you were on the right side. But was that happenstance? You play both sides, or?
I'm normally a vol shorter. And again, the UVXY is an extension of the VIX. It's kind of the fear index. So it's a leveraged version of the VIX. But you also have to remember that it always reverts. And we're going to talk reversing to the mean. It always reverts. It's guaranteed to revert. So as long as you don't go over your head, which I did, as long as you don't use massive leverage, which I was, you should be able to fight your way through it. I was making phone calls to my family that night.
Wait,
so yeah.
Kenny, de-wonkify this for me a little bit. Okay. Like we're talking about the VIX, but not everybody. De-wonkify this. Yeah. Not everybody that's listening might know what that is. So can you just explain in basic terms what the VIX is and what you do with it?
Okay. Well, the VIX in particular is volatility. So people will buy into the VIX when they think there's something going to happen bad. What it basically tries to talk about is the fear that's built into the market. So most of the time you have a complacent VIX and it's very low, and then it has these massive spikes.
What's low?
Low is about around 12 or 13 VIX. So we were talking around 38, 48, 40, and it was moving like a 2% move in the VIX is exciting. I think we were at 200% that night.
Easily.
So it was absolutely incredible. And what the UVXY is, it reflects mostly what the VIX is doing and the S&P futures market. So it was just an absolute bloodbath if you were on the wrong side of that. But again, if you weren't over leveraged and you weren't on margin, you could fight through it. And what was a $65 stock is right back to 22 and just 10 days later. And suddenly, where'd all that chaos go? Where's all the fear? It's gone.
You're going to help me segue. You actually already helped me segue into mean reversion here. So let's just get down to it. Mean reversion describes a tendency for an asset price to return back towards its historical average or mean over time. And it contrasts with the term trend, which is a directional move that just persists. So, you got to be able to differentiate between the two environments here. And as you mentioned, the VIX is a mean reverting asset. It goes up. It's almost guaranteed to come down. But the question is how quickly.
Right.
And I'm just wondering, how did you trade out of that hole? Did you start going short again at the highs? Did you try to flip positions? Did you try to trade it long?
Well, at the highs, I was still in fear for my life at that moment. And I also, it was really bad timing. The market event unprecedented moment. Me having to, I don't know if I don't want to get into my family life, but I was about to drive to Georgia on a 12-hour journey to bring my girl.
We need that context.
My daughter was driving to Georgia, so I was so distracted. We had just had this massive party at my house. I'm like, this is not what I need right now on a Sunday night, freaking
Mother
out.
market knew.
Right, so, you know, and again, in the back of my mind, I'm like, it'll be mean reversion. Don't worry, you'll be able to fight through it. But there's a point where you're like, oh my God, what if it doesn't revert within these 3 or 4 days while I'm sitting here? And of course, the mean reversion was while I was driving on the road and, you know, I just wanted to pull over and start crying for a second, because when the UVXY collapses, it really doesn't have a value other than those brief moments of time. And then it's actually built to go down. If you read the prospectus, it's 128 pages of telling you not to own it long term.
I love that you read the UVXY prospectus. It's something that you're laughing, and we tell people, you know, you need to read the prospectus.
Yeah.
Not everybody has the ability to get through hundreds of pages of the gobbledygook that, you know, the SEC requires, but like you found a use for it.
Well, I just summed it up. It's 128 pages. It says, don't own this long term.
All right. Well, now the audience has read it too.
Did you read it, or did you put it into Chat GPT?
I keep it. I actually use it as they send every time you trade it. They send you another copy.
Oh,
so I actually use it instead of like Duraflame logs.
Oh,
I
yeah.
just crumple it up and put it into my fireplace.
Yeah, perfect. Coffee table book too.
Exactly.
All right, another use for prospectuses here.
I have a question. Is mean reverting a bad thing? Like, usually, like if I were to think that something is going down, I would think that doesn't sound good. That's bad. But if it's going back towards like a historical average, isn't that kind of just like pricing in what it's really supposed to be?
Ooh, you're right on the cusp.
Am I on it?
You're right on the cusp.
Am I getting it right?
You're right on the cusp of VWAP, right?
Oh, no, I thought I'd never hear that
I don't know
again.
if it's VWAP or VWAP. I know. I'm going WAP. I'm sticking with the WAP.
I got to go with the WAP, but get into it there.
Right.
Yeah.
Well, that is basically your main price that things want to revert to during the day. And then again, my godfather of Brian Shannon with multiple time frame VWAP, you're going to see that mean reversion over extended period of times as well. But as the day trader, if you have something that's shooting down, a lot of times you could expect it to then revert back to the mean. And what is the most important price of the day? It's the VWAP price. So again, you were right there. You were skating
right there,
right on the cusp,
So
just like
close.
most traders. You're right there.
So
You're
close to
right
understanding.
there. Yes.
I want to ask you about Pinduoduo. This is a position that you've got your eye on, and how are you playing it? Because China seems to operate on its own fundamentals, which can be good because it's not necessarily tied to what the U.S. is doing. But what's happening in Pinduoduo now that catches your eye?
Well, PDD, again, I'm not a fan of the Chinese stocks. Again, I come from the world of the boiler room, so I've seen every scam and awful stock. Most stocks out of China, you don't even know if these are real companies.
There's audit questions about the auditors, and the Chinese government can come in and say, we don't like you, and then it's kind of over for the capital markets in that company.
Absolutely. But that's what separates us from normal people, the day trader. All we know is PDD, that's it. So it's just back to the price action. And this stock was absolutely cratering on earnings. So then you just go back and look at some of the historical prices. And what people get wrong is that they just see a stock that's down big and they think it's going to revert to the mean just because that's what happens. Not this time. This time there was nobody buying the stock. But historically, there was some support around $97. And again, looking at the VWAP at the time was way, way above where we were thinking about buying it. But that's your idea. So if you can buy something that was 130, 140 just a couple of days ago, now you're sitting here on a 6-month low. The reversion to the VWAP would have been an amazing trade, but it all starts with that dip buying mentality. And again, as a scalper, as a day trader, you're just looking for that advantage. So if a stock breaks 100, you could probably look to see it go to 97.50. That's kind of what happens, these 2.5-point increments. So when it got down to 97.50, we were just like, okay. So other people's disaster is our opportunity. Let's take advantage around the 97 area. And it did bounce back to about 100 and change, and that's your day's pay, as we call it in the biz.
How much of this is actually open to interpretation, even as you look at the numbers? Is the story hidden beneath the numbers? Are you guessing at all?
I think technicals are everything. You know, I think you could see a stock doing something technically, and then, coincidentally, the news hits. So now we're playing the event afterwards. So the event has happened. They've already announced how awful these earnings were and whatever else they had to say. Now you're back just with the math. And again, when you're only looking at math, then it's simply risk reward. This is where I'm willing to take. This is the risk I'm going to take, and this is where I think the stock's going to go.
Right.
And that's what's great about it. It takes the story out of the equation. It's just a catalyst. The stories are always a catalyst. That's why I love earnings season, because that's when you have the biggest catalyst and you have these disasters. That's when you have these monstrous moves, and then the reversion to the mean comes into play all the time.
And I guess this is you're talking about a lot of stuff for the day trader, not really for the long-term investor.
Well, when we live, I say we live in the nucleus of the stock. So from here, the price action that you witnessed today you can take that to the next level. If it holds today's lows or today's action will give you a very, very specific VWAP in the future. So you could take this earnings season and then 3 months later see where we are from that point. So again, this major event really you could take it from the day and turn it into a week, month, or a year.
So this sounds like my dating life. So in other words, you take something that it might be a short-term thing, and then it just ends up a long-term thing.
And then it's gone.
Oh,
wow.
Jared, I love that.
All right. Well, yeah, this would be a great time for a break, which we're going to do right now. But coming up, we're going to be digging into retail investing trends, including AI adoption and who wore it better for the true stars of the galaxy. We are back, and this episode brought to you by the number 59. That is a percentage of respondents in a new trading survey who said they're likely to use AI in their trading decisions. The study was commissioned in the UK, but I will ask you, Kenny, how much would you ever trust AI as part of your tool set, and then would you ever cede any decision-making to it?
I'm still going to make the decider. I'm the decider. I decide.
I get that.
Right. So, but the AI, we are sort of using it already because algorithms are using AI.
Good point.
And we're focusing on the technical trading, and there's AI doing that trading already. So in theory, we are AI traders.
It's your competition.
And I actually might be a robot. I'm not too sure if I'm here or not. But this AI it's not going anywhere. So again, I think there are going to be more quant firms, more technical traders, and there are going to be just specific robot firms. You will hear the first robot firm.
Be some D.E. Shaw offshoot.
Absolutely. And it's just like you're going to be investing. But the only thing is, is it going to turn into Skynet? Or are they going to be friendly robots? We don't know. And they might just want to ruin you.
They might not just hit the VWAP all day. They might trick you.
That's right.
Let it go
they
through.
Might fool you to fund their nefarious ways.
Right.
We don't know yet.
To me, AI seems fantastic, maybe for people that don't know that much about the stock market. You put an article in or something and say, summarize this, or an analyst note or whatever, but I'm a little skeptical of, like you said, an AI making a decision. Do you think there would be a big market for people to go to like an AI-run firm or hedge fund? I don't know how that would work.
Absolutely. The one thing I've learned in this business, nobody wants to think.
Oh, very true.
People want it. They want it to be handed to you. So if you're telling you, here, I've got this robot that's going to actually serve you food and give you good stock picks, they're going to be in. They're definitely going to be in. It's going to be huge.
You think that they're going to be able to actually tell you which stock to invest in?
I think it's happening already.
Absolutely, absolutely. And where I thought you were going with that conversation is that if you type in some of your ideas, it'll come up with ideas about, let's say, like, all right, I'm into robots and microphones and space exploration. Thanks, Kenny. I'll tell you about a few companies that are into robot space and microphones, and that it'll give you the idea and even write a paper about it. So
that's intriguing.
I'll tell you what I've done. I actually did this the other night. I put in a research paper and some stats about Tesla, and I said, give me a bull thesis on this. And it did. It printed out this very in-depth report that I'd asked for. And then I said, give me a bear thesis. And it was equally convincing.
Right.
It's very good at playing both sides, but at the end of the day, you got to make a decision. And right now, I don't think AI is in the position, the way ChatGPT is put into place right now, but I see it evolving there because there's some kinks to work out, but I think it will get to that place where it can make an informed decision. And like anything else in AI, you get in what you get out what you kind of put in, and you put in a lot of effort, you get a lot of good stuff, and if you don't, you don't.
Equally scared and excited, I guess, I suppose. So Kenny, you operate a trading room. Kind of tell us about your experience, trends you're noticing apart from AI. What are you kind of seeing out there right now?
Well, right now it's AI, but for us it's the chips. Again, the Nvidia story has been beaten to death, but it's not going anywhere. So what we've started to notice is that space, rockets, robots, and how the chips are influencing your space, rockets, and robots. So, robots in space, space robots, all that stuff. So what I've, again, since I've been trading, that you find where the trend is or the story, again, whatever it was, years ago when semiconductors, there was something called superconductors. And like I said, the market is fatty, and then it just, those fads go away, and every once in a while, one stock sticks around. But right now, space, there's a company called ASTS, right? And the idea, again, I could be right or could be wrong about the story. I'm always last to read about what they exactly do, but they're putting satellites up there to make sure everybody has the internet, and it's fantastic. And once that stock, it got from 5 to 750 to 10 to 1250, the actual price of the stock attracts more people. When a stock is sitting there at $5, it's a $5 stock, nobody cares. But when you see it start to gain traction, next thing you know, it's 20, 30 and starts to, consolidate up there. What do we have here? And then you've got these robots. I don't know if you've ever been to these campuses where you actually call in to get a food delivery, and a little tiny robot brings it to you. And there's a company out there that's doing that. I believe that's what Serve is all about, SERV. And then if you've ever been on a cruise, there's those robot arms that pour your drink for you. Again, I needed it quicker. All right, robot. I can pour my own vodka. This is robot arms are putting the drinks together. So again, the AI being powered by the chips, going in rockets in space, and it's just a great moment right now in the stock market. And I don't know if that's going to fade too soon, but what happens is the weirdest stocks will just emerge. They'll just name the company we love robots or we love space, and everybody will jump on it. Meanwhile, they have no business model whatsoever. You still got to be careful when these fads become.
I remember 3D printing. So let me ask you, because we're talking about all this new stuff and these technologies operate in hype cycles. So there's lessons that we can learn about the past. I'm just wondering how the lessons of risk management just kind of stay constant throughout all of this, or hopefully stay somewhat constant as you're evaluating all these new opportunities.
Oh, risk management is exactly where it's all what it's all about. So again, as much as you, again, what did you say? What cycle? Hype cycle.
Hype cycle, yeah. The
like
S-curve, the Gartman hype cycle.
I like that. So when the hype cycle is over and I guess the top tier will stay top tier, and usually the mid will start to fade. It's all about price. It always comes back down to price. So if you've got this lovely stock and it's doing all these fantastic things for you, and next thing you know, it breaks that magic price where you believe it's going to go lower, story's over.
It should be, but a lot of times you're invested in this stock, and you've made a lot of money. You want to hold on to it, but you don't want to miss the next opportunity.
Right.
How do you stick with the discipline?
Well, again, price. Price. So that always influences what I do. And again, when I'm surprised, like a stock like ASTS, normally when you see a stock go from 5 to 10 to 15 to 20, as a bearish, I'm bearish minded. I like to short these stocks, but when they don't cooperate and they tell you, you cannot short this one, we're not going down right now, you just join the winning team and then go find the one that is rolling over.
It is impressive that you make money as, I'm not going to call you a perma-bear, but bearish, cynical aspirations.
Right.
Something like that.
Trust, no, you have to earn my trust.
All right, we want to segue now. It's time for Who Wore It Better, so take your protein pills and strap your helmet on. Guess what? We are blasting off in search of investing opportunities. I told you that happened.
I love it.
In the final frontier, space. Because as I am fond of saying, the total addressable market, or TAM, of space is infinity, right? In theory. And Kenny, I know you've got your eye on some of the companies. You've talked about them already. AST, that's Space Mobile. We also have Service Titan, which is Serve. Rocket Lab, RKLB, Rolls-Royce Holdings, which, as you've told me, is different than the Rolls-Royce engine maker.
Right.
Lunar. So tell us, where is the opportunity?
Well, right now, the opportunity, again, I hate to beat the dead horse. I love trading. Again, some of these stocks have impressed me to the point where I want to put some money to work. And what's great about it is that the more popular the stock becomes, they put out options. So now you can limit your risk. So ASTS, that's interesting enough where I could put some money to work and have exactly, I'm like, okay, if I think the stock's gonna go to 50, maybe have these wild dreams of it going to 100, I could position myself there. If it happens, fantastic. If it doesn't, limited risk. So as far as I'm concerned, I'm just looking at these same stocks and waiting to see this consolidation. Whichever stays strong, they're probably gonna make another leg up, and the ones that consolidate and break down, we'll probably never hear from them again.
We don't see Virgin Galactic on this list we have here. What are your thoughts?
Billionaires blasting themselves into space, right?
He looked like he was having a good time when he went to space. I'll give him that.
I got to tell you, I had a long history with that stock. That was when SPACs were.
That was maybe peak SPAC.
That was number one SPAC.
Oh,
yeah.
Wow. So
that was like beginning SPAC. That was when
setting the
SPACs,
precedent.
That was when people were like, what is a SPAC?
The first ever SPAC.
It was the first SPAC that I was involved in.
Wait, tell our viewers what a SPAC is in case they don't know.
It's a special acquisition. I don't even know what a SPAC is. Something like that. Yeah.
Special purpose acquisition vehicle.
There we go. Let me ask ChatGPT.
Right. I don't know. It starts at $10. They try to sucker you into the stock, and next thing you know, it either goes to 30 or 40.
We're going to put a different definition on screen.
Zero. Yeah.
Oh, $10 is real. I did a whole explainer video on it once.
Yeah, the $10 par value.
Yes.
Right. And you just don't know. And it was all the rage. And now you don't. Now it's like you're a pariah if you even mention the word. But yeah, space was that got caught up. Then it became the SPAC into the meme. So space never had a chance.
Yeah, it was a meme stock too.
Right.
Crazy.
Right. And then it just went absolutely, blasted off for,
Thank you.
Pardon the pun. And next thing you know, it went right back to zero and now has done a reverse split. That company is absolutely worthless. Yeah.
If you're not comfortable investing directly in these stocks, do you think just a space ETF is a good play right now if you're more of a beginner?
There is a space ETF, right?
Yeah.
I think that it is.
Should you do it?
I like it.
Okay,
I do like it. You get some Boeing in there also. You'll have some big guys in there. It's not just your speculative plays. You'll have some solid core holdings. But again, do your own due diligence.
And my follow to you there is we've talked a lot. We talked about chips. We're talking about space. Is tech just generally a safe place to be right now for people? Like, we haven't really discussed much else in terms
How do you define
of way
safe?
of sectors.
Well, right now, I again, as the bear in the room most of the time, we just had this massive event. And the idea is that it frightens people and people wait for the next shoe to drop. So while they're waiting for the next shoe to drop, what have we done? We've rallied every day since the drawdown. And again, I think some of this might be pre-programmed. Again, I sit in front of screens for 25 years. I'm a little twitchy. But when you're getting an unprecedented VIX attack, the market's falling off the cliff, but yet the QQQ goes to 420 to the penny, holds it, and that's where the rally begins. Come on now.
Elon Musk might be behind
Come on now. This is all being controlled by some AI quant firm in space that's using rockets. So it is absolutely incredible. But the environment right now, because we've had such this massive bounce and the volatility has come crashing down, it's setting us up for that complacency already. So we've gone from boom to bust to boom again, and now we're going into September and October, which is notoriously a weak time, and you'll get some
crash time.
Yeah, you'll have extended, some more volatility. So we go right back to that UVXY. If it starts to show us some strength again, you could expect some more volatility in the market. But I don't feel safe actually right now. I'm that guy. I'm waiting for the other shoe to drop, especially because we have rallied. Not only did we make it all back, we made it all back and then some. But this market it's not bearish. It's not a bear market by any means, but I'm expecting some more volatility.
We got to leave it there. Believe it or not, 24 minutes has elapsed. And be sure to check out all our other episodes of Stocks in Translation on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms. That would be YouTube, Apple, Spotify, iHeart, Podtail, Pod Paradise, and more. Thanks for joining us. And thank you, Kenny.
Thanks
and
for having
Sid.
me.
That's it for Wealth. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton coming up at 3 p.m. Eastern Time. You won't want to miss it.